Good morning, good morning. How are we? Happy Valentine's, Peter.
Happy Valentine's Day to you, sweetheart. How are you doing?
This was not my dream to be spending Valentine's morning with you.
It's a nightmare.
It's not far off.
You got your account manager whipping you hard on Valentine's Day morning.
Into a frenzy. Well, I'll tell you what has been whipping me hard this week. It is my portfolio. Oh my gosh, since that CPI number came out on Wednesday, kicking.
Yeah, it's been a difficult one.
The tasty account's been good. That's chipping away as it does. But, oh my goodness, it's a face-ripping rally, isn't it?
What's hurt you the most?
Just been short.
Yeah.
But also I'm not the only one, clearly, because we've got some numbers on how hedge funds have done in the last few days, and it is brutal. So we're going to have a look at all of that. We're going to have a look at, we've got a new function for showing you the upgrades and downgrades. Excited about that.
Oh, nice.
And then, we'll go through NatWest results.
Yes.
We'll go through the Hermes results, Montclair, sorry, as well. But what else have we got coming up, I hear you lot ask? Well, 8:40 a.m. trade expectations with Chris Beauchamp.
Okay.
8:58, we've got live from the trade desk with Axel.
Very specific timings these days.
Well, yeah, you see, 8:58, the idea was we can get all sessions open in there as well.
Okay, yeah.
So we can ring your bell twice on Valentine's morning,
lovely.
Peter.
Very nice. Good.
And then, you please tell us what's coming up at 9:55 there.
So we've got the week ahead with Isar, which is always a good one.
With Isar who?
Bhattacharya.
Well done.
Yes.
Good effort.
Thank you.
It's the daily test. You get a round of applause as well. Now, producer Fred is away. He's gone on holiday. He's taking the wife off for Valentine's.
Oh, very nice. Where to?
He's
Paris?
French, isn't he? Yeah, of course. He's off to...
Lovely.
Yeah. And he's going to drink some wine as well.
That's it. While the cat's away, the mice will play.
The cat's away. The mice, Caleb and Terence, in the gallery today, have started playing around. Oh, this is going to be a long one, isn't it? We've got new sound effects, we've got new boxes, so we're never out of vision now. We can always see your pretty face, even when we're presenting.
Excellent. Good. More the better.
Let us know what you think of the new look. But who's joining us on Valentine's morning? Who is as excited as we are to be here? Dave G, Blake 7, good morning to you. Jugger. Juggers, you've changed your name. You're not Jugger anymore. You're just Jugger.
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 This is your band of followers.
And maturing. That's something that I've yet to find. I tell you what I tucked into last night. Do you remember the bottle of wine you got me for Christmas?
Oh yeah. Yeah.
So
I thought you drained that at Christmas.
I drank the red.
So you dipped into the white.
Dipped into
Nice.
the white, and
Which was the Peter
Pan.
Yes, that's the one.
Peter Pan.
Yeah, nice hints of peach. Lovely.
It really it reminded me. The closest I could describe it would be a Riesling.
Yeah. No, it was nice. I had fun choosing those in the crypt at Fortnam & Masons.
How does that look when you have to go and choose what you're going to give to everyone?
I'll give you that, but someone's got to do it. No, it's good. It's a very, very old room, obviously in the crypt. Basically, you go through the wine shop, and then there's a little sort of door. You go down some stairs.
Is this Berry Brothers?
No. It's Fortnam & Masons.
Fortnam & Masons, sorry. Right.
They've got all the bottles that have been opened throughout the years on the wall. So, like, if you're a bit of a wine buff, there's some good stuff to look at.
Right.
And then we worked our way through a number of different brackets and all sorts of stuff, and it's good.
God, that's awesome.
We start at about 5:36, and we're done by about 8. But it feels like midnight. And then you come outside, and then.
And on how many do you think that you get to taste?
I would say we probably tried 10 red, 10 white.
Oh, fantastic!
Yeah.
God, that's a proper wine tasting, isn't it?
Yeah, definitely.
The best wine cellar that I've ever been in, it's a place, if anybody's watched the original Wall Street movie, where Michael Douglas is having lunch and Bud Fox walks in.
Lunch for wimps.
Lunches for wimps, but he orders him a steak tartare.
Yeah.
And that is a place called 21 Club in mid-Manhattan.
Okay.
And I think it's actually shut down now. But it was during the 30s when they had the prohibition.
Yeah.
Then the owner of this bar said, nah, we're not having that. We're going to have a secret place for people to come and drink. And it's still there, the big wall, right? It just looks like part of the wall, but there's a tiny little keyhole.
Right.
Literally with a wire key. And they still have that today. And you get in, you can unlock it, you go through, and they've got the most incredible wine cellar, including a shelf of all the bottles of wine that were opened for celebrities, presidents, John F. Kennedy, Marilyn Monroe.
Like a wall of fame.
It is, but it's their bottle of wine that was never finished. You know, this tiny little bit, still corked, and it's written on the label.
Oh, very nice.
So it's like real trip down.
Your name in there?
No, they didn't. I finished mine. Funky Gibbon, good morning to you, British Indian. The Hood increase now. What's Hood? Robin Hood, of course.
Robin Hood, yeah. A feather in its cap, you might say.
Very good.
Yeah. No flies on me, mate. But yeah, they smashed it really with results.
They did.
They've come out first year of full solid profitability. They've moved from being a kind of, stock that was kind of associated with the meme craze 2020 when people had stimulus checks and were just kind of punting anything that moved, GameStop, AMC, all that sort of stuff. And it was not really regarded as a traditional broking house, not like a Schwab or a whatever. But all of a sudden now it's kind of managed to hold on to those clients and grow it, and now they're adding more and more products.
God, the performance has been incredible.
So finally back above the IPO price as well, which, I mean, they were like 85, 90% off.
Yeah.
But yeah, a decent recovery.
Well, I tell you what, we'll go through all that and in a section that you are hoping for this evening. Let's go to overnight action. Right, so let's have a look at the front page of the newspapers this morning. Financial Times telling you that Europe must respond to the Trump electoral shock, says Macron. So this was to do with Trump unveiling the reciprocal tariff plan to hit trade partners. And that sounds like it includes the UK, but we completely ignored it. The futures went down for about 10 minutes. And the prospect of America putting 20% tariffs on the UK doesn't matter. No, we just don't believe any of the headlines anymore, do we?
Well, yeah, I think it's a bit of that, and then it's also the fact that in order to get these things through, they still have to get kind of put through the House. And everyone says, you can do these executive orders and whatnot, but realistically, it has to be approved.
Yeah, and it was a matter of weeks to months.
Yeah.
It wasn't imminent, which I think...
the more things that you say that you can't enact, the less impact, I guess, those things have. Like he was saying, about all the US...
Oh, thanks, guys.
They're bringing up the US, military aid. They were going to reduce that, weren't they? And they've come around and turned that around, saying you can't do that. So there's a lot of things that you can say, but then not actually do. So it's almost the market is shrugging these things off. But it does feel somewhat strange. Like yesterday, looking at the DAX.
Shall we have a look at that?
Continuing this upward trajectory.
Was that the melt up and the burn off? That's the question.
Yeah, I mean, look at all of those highs. You could have said that on any of those. And the big elephant in the room being, what's the impact of big tariffs on their automobile motor trade? And it was up until 6 o'clock yesterday. He could come in and slap those tariffs on, and it just didn't shake anything.
Yeah, but we can have a look at exactly what happened when that tariff news came out to the futures about 6 p.m. last night. You can see, let's get right in there. Yeah, there we go. So that was the tariff news, and we dropped from 22,500 down to 22,464, but we are much of muchness for the same. So
That's 36 points.
Yeah.
Is that all the drop was?
Um,
Your chart. What do you mean? Have you missed the figure? 22,500 to where?
to 22,477. Yeah. 50 points in the DAX. Nothing. 60 points.
Yeah, nothing.
Yeah. Bulletproof.
Yeah. Until it's not.
Well, what I have taken advantage of all this is to add to my MDAX. So let's have a look at the MDAX in comparison. Not quite the same story, but it is starting to move at least.
Was your pairs trade to long this and short the other?
Short the adult.
And at the moment they're both just going.
Yeah.
Right.
Yeah. But this one's got a long way to make up, and some good German election news, and we could be up and away. But yeah, it has been a tough week. So it's a case of how have hedge funds done? Well, let's look at yesterday's performance, and this is the real pain on the streets of Mayfair, right? Fortnum and Mason wine bar last night would have been full of hedge fund managers drowning their sorrows, because the most shorted basket, right? So this looks at what hedge funds are short of. That was up 3.4% yesterday. Okay. Now the long basket was up 1.4%. So that underperformance of 2%, right? When you're talking about $500 million, you lose 2% in a day. That is horrific when you're only meant to make between 1 and 2% a month, right? So the year-to-date performance wiped out in a day. When that happens, that's when you have to start cutting. That's why I think today could be particularly tricky, because it's going to be full of people cutting their positions. Non-profit tech up 5%. The meme stocks up 4.6%. So that means that the crazy retail bunch were also involved as well. Crocs, MGM, and Molson Coors.
Molson Coors.
Molson Coors.
Yeah.
All up between 10 and 20% on numbers. So just, there's it's been a big couple of days, and normally the market doesn't come straight off after that.
Yeah.
So I think I'm going to look at some upside for expiry tonight that just has that squeeze up towards 61.50. I think we finished tonight 61.42, something like that on the S&P.
You were saying yesterday, wasn't it, that the Goldman strategist was saying that it's basically topping out, and this is the last bullish note that they were going to be writing before Q2. Right?
Exactly.
Yeah.
Exactly.
Interesting.
Yeah.
But yeah, I guess in terms of overnight stuff as well, we had some fairly interesting numbers from some of the names in the States that obviously a lot of our clients are quite.
Of course.
Coinbase being one of them.
Right. Let's have a look at Coinbase then. Jumping, but it was a volatile aftermarket session actually for Coinbase, wasn't it?
It was. The numbers came out. It popped to like 302, dropped down to 282, and then quickly turned around. Where did it finish up?
293.
Okay, fine. So in the middle. But yeah, I mean, they were helped, I think, by an influx of trading post US election. With the general consensus being that the Trump administration is going to make the rules on crypto easier.
Right.
And they got a big jump. Airbnb as well.
Yes. So Airbnb getting a lot of target price increases this morning, as you can see on the screen there. Dan Ives at Wedbush, biggest bull in the world, goes to 175. Canaccord go to 190. RBC to 160. And let's have a look at where that settles. Airbnb up 14%, which is exactly what we said the expected move when we looked at it yesterday. Exactly on the expected move. So, Airbnb there.
Shot 140 to 160 straight away. And basically, had a huge increase in earnings per share, and also number of bookings over the year. And also, I think they did a lot with their kind of non-profit side as well for the post the fires in LA.
Of course,
It's been like housing X amount of people with donations from the owners and all the rest of all that sort of stuff, publicity-wise.
But EPS of 73 cents against mean expectation.
It was an EPS loss last year of 50 something, so it's a huge turnaround.
For 50, 73 against 58 expected. and revenue's up 11.8%. So a beat there as well. But yeah, just a huge. Do you Airbnb much?
Very occasionally, if we're doing like a big sort of group of friends for the weekend type thing.
So like a place for 12 people kind of thing.
That sort of thing, yeah.
Yeah, that's what we used to do that in New Zealand actually.
Yeah. Nice.
We managed to get 21 people into a 4-bedroom house once.
Oh, nice.
Yeah. The neighbours phoned the owners, and the owners were going crazy. And the biggest complaint was that there was also a dog there. We said no pets. It's like, it's not a pet, it's Layla.
Let the sheep off over there, I guess.
What's that?
I said it would annoy the sheep.
It was, we were down, it was right on the south coast, the south of the south coast.
Yeah.
South of the South Island, I should say.
Beautiful spot.
It was stunning. Great weekend there. Andrew McKelvey expecting a Valentine's Day massacre of the share price at Wood. So Wood Group not out of the woods yet.
Nice.
It seems. That's. Have you seen numbers there this morning, Pete Ward?
Let's have a look. Wood Group sees negative financial results in 2025. Reviews refinancing options. So that's all I've got on it so far.
Right there,
we can have a look at that one in about 4 minutes when we get the pre-market indication. Let me check as well.
Excellent.
Expected openings. 1 second.
Expected negative free cash flow of 150 to 200 million. Negative free cash flow, not the way you want to do forward.
Yeah. So Singers, we've got them calling down 3%. So let's see where that one comes in. So NatWest, that was one of the ones we were going to...
Yeah, have a quick look at NatWest, and then we shall cover Napster's idea. Well, actually, we'll cover that in fast markets. We're going to do fast markets at about 8:15 this morning. We're going to look at all those defence stocks. Thank you, Napster. Happy Valentine's. Right back to you. So we got NatWest. Is this going to help my Lloyds?
Should do.
For the breakout? We think so.
Yeah, a little read across. I mean, they're indicating to be up 2%. Numbers were better than expected. We've seen it go up. I think it went up 100% over the last year. 10% at the start of this year, and it's the year whereby they're expecting the government part of it to come out by June, I think, of this year.
Right.
So it'll go back to being, fully owned by itself, and also talk of a buyback.
Will that help her? No, I guess it's not.
Does it help them?
I mean, she only needs 1 billion, doesn't she, to get through the mess that she's in at the moment. So
I guess given that the price of their investment's gone up, you could argue it's good. Yeah, I was thinking to myself this morning actually about how bad that investment decision was to sell all of the UK's gold at $600.
That's what you were thinking about?
Yeah.
Interesting.
Yeah.
Yeah.
Genuinely.
just a rage at Gordon Brown.
Well, yeah, no, I looked at, as I do in the morning, looked at where things were, and I saw gold sort of 29.30 or something.
Is that what it is?
29.70 maybe. Either way, it's on the ascent to 3,000.
Yeah.
And I was just like, Christ. Yeah. Bad.
So 35 billion pound market cap now. That's incredible. NatWest is almost as big as. Jeez, that is size in the FTSE. So
yeah, I mean, I've got the actual details if you want it, but yeah, basically, pre-tax operating profit has beaten. Net interest income was broadly in line, a little bit above actually, and 15.5 pence final dividend per share, likely to return to private ownership by the summer. Some nod to a buyback, but not actually. It says considering buybacks as maybe being appropriate.
Right.
So it could be a way to take the government stake, buy up themselves.
Yeah. Okay. Good. Right. Let's get into commodity world then. What have we seen overnight there? A little bit of a recovery in oil. And we've got gold, as Pete alluded to, 29.35 now. So that must be all-time highs.
Yeah, I think so,
yeah, intraday.
New sound effects like
not quite. Yes. Where's the sound effect, gents? Come on. Well, gold at all-time highs, and we're all got bucket loads of it. So you have a guess what?
IG gold for those who didn't know.
Right, platinum 1008. That is a lesser known fact, actually. Tell the people what IG originally stood for.
well, it still stands for, I guess, it was Investors Gold. And that was because the company was founded by the original owner, Stuart Wheeler, which was a way for people to speculate on the price of gold, because at the time you could only buy a finite amount of gold per person. And so what he thought was, right, let's derive the price and give people the ability to speculate, buy or sell on the price of gold. And that went from one market with a few wealthy buddies to 10,000 markets and 3.5 billion market cap.
And it was over 50 years ago.
Correct. Yep.
Interesting.
There you go. Bit of knowledge college for you.
There you go. Good stuff. R6N, good morning to you. It is Friday indeed. Will USA indices lighten up before going into the weekend? So the problem I have is hedge fund world is in a mess, right? They're more likely to be short.
Is it in a mess? Like, you know,
it's had a messy week, let's say.
Yeah, but comparative to where it's come from, surely that's been the buying momentum. So if you benchmark it, go P&L Jan 1 to now, you might have had a bad day yesterday. You could probably still chalk it all off and be well up.
Traditionally, you find if you get this kind of move on a Wednesday and Thursday, normally it's a drift higher.
What if you go to bed early on Tuesday?
Then I wish I had.
Brush your teeth on a Friday. You've got all these on wives' tales.
They're all in the almanac, means they're true. Chris Schwab, good afternoon from Sydney. There you go. Thank goodness it's Friday. You'll have the music out already. Good afternoon from Sydney, New South Wales, 6:50 p.m. Still bright, not dark yet. Look forward to hear the Palantir commentary. Palantir, so I was part of a podcast last night that was described as the finance version of the Avengers.
Right.
Because there was 7 of us all on the same TikTok, podcast kind of idea, or live chat. Neil invests, invest with Tom, Michael Taylor shifting shares, Dr. Joubert's finance.
Where was this?
Just online.
Oh, nice.
Just sit in my house.
Yeah, lovely.
But we were speaking about Palantir because I think it was invest with Tom. 15% of his portfolio is now Palantir.
Wow.
And it's just the great thing about these things is everybody's got different areas of expertise. And I said, well, would you like to sell it 10% higher? And was trying to inform them about selling a call, so make it into a covered call, because everybody knows it's run so far that the chances are it's a bit like Nvidia did. It jumped up to 1,600 and then dropped, and then that's been the ceiling ever since.
Yeah.
So Palantir is the same. Palantir is going to drop back down to $100.
Maybe. But we thought that at $60 when it went from $30, and then all of a sudden it was $90, and now it's $120.
So, and I'll tell you the reason I think, and it's down to Dan Ives. He is the biggest bull in the world, right? He thinks this thing is just the best company ever, and even Dan Ives only has $120 price target, right? And it's right there. Every other price target in the world is realistic at 88. Okay? Yeah. So that 120 is the absolute ceiling. If the biggest bull in the room says they can go to 120 in 12 months, then you got to take the risk-free rate off that, obviously 5%. So
what was it their CEO said on the morning show? Didn't he come on the morning show saying that first thing he wakes up in the morning is how to destroy America's enemies? Yeah, they weren't expecting it. Really bullish stuff from the CEO.
But not just America's enemies, because they are in the NHS as well.
Indeed.
So they're also, they're a big part of the NHS tech here. Right.
They're trying to destroy us.
What else? We haven't looked at the shocker, unfortunately, for London. London has had a really tricky 48 hours. So Shein has delayed its IPO to the second half, right? So that's the biggest IPO was biggest IPO. I've just seen you away from the numbers. I'm going to come back to that in a second. Biggest IPO is now basically cancelled for the first half, going into the second half.
Yeah.
And now,
end of April, wasn't it? I think.
What's that? Sorry.
It was meant to be the end of April.
Meant to be end of April. Now, you're talking maybe October, November, something like that. And then this one, a second one, Unilever, not going to London. It's going to be, the primary listing is going to be Amsterdam and that is, they've got a picture of my girlfriend. Unbelievable. They put that up on purpose for Valentine's, doesn't it? Morning, darling. Yeah, there we go. So Unilever has dealt, it's the London Stock Exchange, a second blow.
Yeah.
How do we recover? How do we?
I think, what, as a UK index, how do we recover? Or
just as a country being able to attract
capital market action.
Yeah.
Do more of it, I guess. But it's chicken and egg, isn't it? But yeah, I mean, the Sheen one, I mean, it was kind of shrouded in bad press as well as being a high valuation. It was also not the most, kind of ethically palatable listing. And yeah, they were talking about that sort of anything, any sort of freight that has a valuation under $800.
Yeah,
would be taxed.
Exactly.
And that's why they're
de
not on the head, which puts puts a bit of a missile through their business plan.
Time for break, Pete Wards. We're going to go to a quick 3 minutes here. Then we're going to talk about Vodafone, clearly a massive seller in the market, matching off Goldman Sachs. 38 million shares bought yesterday. If their prime directive is to bring volatility into the stock, they've nailed it. Good stuff. Right, time for a break. We'll see you in 3.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
To find a list of all your open trades, click on Positions in the sidebar menu on the left. Here, you'll be able to see key information about each of your trades, including the market name, the size of your position, the opening price, the stop order you chose, and your limit order. You'll also be able to see your profit and loss. Positions are normally sorted in descending order of your latest trades. To change how your positions are listed, you can filter your view by clicking on your preferred factor, like which trades are making you the most money, by selecting profit and loss. You can edit your limit order or stop order by clicking on the figure and entering your desired number. Lastly, you can close your open trades by clicking on the Close button next to the relevant trade.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
Welcome back. Friday the 14th of February. Welcome back to Trade Live with IG. for the opening bell. We're almost there, Pete Ward. You excited?
I am indeed, yeah.
Right, we're quickly going to show our upgrades and downgrades. There's not too much around this morning. Clearly, the analysts have been out as well. But Heineken raised at Oslo to €93 price target. Bunzl, 39.50 at Redburn. Harbour Energy raised by Peel Hunt. And ignore those two at the bottom. Those should not be there. Arcelor is equal weight at Morgan Stanley. Chart off. Thanks, guys. So that is our new upgrades, downgrades sheet. A little practice today, and then we're going to kick that off from Monday.
Nice.
In style. So you will get your biggest upgrades and downgrades delivered to you every morning before the market open. Speaking of market open, Pete Ward, where's your bell?
Yeah, I don't know. I wasn't giving it actually, but we are open. Open and trading. It's got FTSE around 87.56. We've got NatWest. They're trading now at down a little bit at 1%, 431.30, 432.30. And then what else have we got at the top of the board? Fresnillo, Glencore, Reckitt's, Antofagasta, and then at the bottom end, actually NatWest is at the bottom, down 1%. But 1% at the bottom of the board is not a particularly bad day, is it?
Flutter up 4%. What was that about?
Look.
Right, Hermes up 4.4 as well on the back of numbers. Great numbers from Hermes. Ubisoft up 2. Napstar is our Ubisoft expert, or at least the son playing the computer games is. LVMH up 2. Puma up 1.5. Rheinmetall carries on. That was a shocker yesterday as well. I had to cut that one. Up 40 basis points.
760.
760.
You saw those at 692, didn't you?
Yeah, I did indeed.
Nice.
Yep. Thank you, PCM. Thankfully, it didn't hold them all the way up to 760. Yeah, that was a quick cut yesterday morning.
Yeah.
Entain up 2.6. So there's clearly something positive in the gambling land. Glencore up 1. Anglo-American up 70 basis points. SSE up 1.
Yeah.
Antofagasta, that's good. I've still got that. Where is our favourite?
What are you looking for?
Stock? Got Vodafone, of course.
Voters. Let's have a look.
Where is Vodafone? Geez,
66.92, 66.98, down 0.5%.
What? Oh, I don't know what to do with this one now. So I'm short against my options. Goldman's are just having a complete laugh with what they're doing with this this buyback. But no, I think I'm going to buy back my short. It's in the 65s against my short puts. But yeah, this is just clearly yesterday what has happened, and you can tell as each day goes by. They're buying 28 million to 27 million shares in the market. On the day it goes down, they're doing it to find a seller. The seller comes in, matches it off, and so there's no effect of the buyback. So hence it drops on a day like yesterday.
Right.
They ramped it from 65 up to 69, buying back 28 million shares a day. That obviously attracts the seller, and the seller comes in and smashes it.
Might be a stupid question, but if there is a known seller and the company is doing a buyback which is out there and released, why would they not do a block trade?
Well, no, because the company has to buy back stock
On a daily...
over the day.
So, yeah, I got it.
Maximum percentage. I did ask the CFO, I said, why, if you're so confident and you've got 4 billion euros to spend, why don't you go and do 1 billion and you know a dawn raid and bid 70p for the stock? And he said, I would love to, but there's too many regulations around percentage of volumes and everything like that.
Makes sense.
Right, what about our UK banks outside NatWest then? Where are we outside those? So BAE Systems, Napster, as you said, Trump talking about getting getting international getting countries to do two things. One, buying American defense.
Yeah.
Right? So buy American when it comes to defense. Two, he's talking to China, Russia, and others about cutting their defense spending in half. Right? Now, you're talking $500 billion a year if America cut its defense spending in half. So that's seeing.
But wasn't he also
spend
saying that
1.4.
he was pushing for NATO contribution towards defence to come up to 5% of GDP?
That's right. He's arguing that European countries spend more,
Right.
so America can spend less, but the European countries have to buy American.
I see. Okay, yeah. It's a tall order.
Otherwise, you get a tariff.
Yeah. Yeah. But they're the ones with the weapons.
They're the ones with the weapons.
Dangerous game slapping tariffs on companies like that. They've got their numbers on Wednesday, actually. One to watch next week.
BAE.
Yeah.
Nice. Okay.
So we'll see.
Any other interesting ones next week?
Let's have a think. 1 second.
European. Elsewhere, we've got Siemens down, 1.7%. Havas 153. That's it. There's the one I want to buy. I'm in at 149 to buy that. Havas. Bayer down 80 bips. BMW down 80. Yeah. And Adidas. I am short that one. I was in to sell that. It's 261. So I'm very long Deckers and I'm slightly long Nike, but yeah, now happy to short Adidas against that. The day of the Samba is running
Maybe.
old.
Yes, indeed. Yeah, it's one you've been playing quite a lot recently, isn't it? Yeah. No, you mentioned.
What's that? John Wood. There you go, Andrew McKelvey. Down 29%. 30%. What is going on with this company?
Wowzers. 30%, that's huge. Well, I guess, yeah, that announcement this morning on the refinancing is bad news, right?
Straight into volatility auction as well there, John Wood. Wow, where did it actually open? So get that on the 1 minute. Yeah, opened at 49. Now in volatility auction at 45.60.
Okay, here we go. I've got it on the L2 screen. Right, yeah, so down 32.67%, indicated on cross 44 in 50,500 shares, 877,000 shares taken place or traded hands so far. So it must have opened and then
another volatility. Yeah, wow.
On the downside. So yeah, big moves there. Closed yesterday at 65.35. So.
Commiserations if you are in that. That is a painful one. I'm surprised I'm not in that after the week I've had elsewhere. Right, Legal and General. How's my Legal and General doing? Where are they? I sold some puts in Legal and General yesterday. 230 puts I sold for 4.25 pennies. So that is, and that's of course before the dividend comes out. It's a 15 pence dividend. 15 pence on a £2.40 stock.
Yeah, they are 242.50. They're small up.
Okay, we'll take that
Yep.
on this week. Right, FX and commodities world. Where are we, Pete?
So yeah, cable. After a few weeks ago, it was down in the doldrums with all the talk about the gilt markets and whatnot. It's now bucking the trend and back up above 125.50, trading 125.78. I had a note this morning come across from Axel, our in-house analyst. He looks specifically at technicals.
So can we just have a bit of a round of applause for the guys in the gallery? What they've just show Pete what you've done again with the full screen. That's it. We listened to the people at home that said, Rich, I can't see your text on the screen. You got to do something. So Terence and Caleb have been working on that to get it full screen so we can see the figures better for you.
Yeah, nice.
And
that's good.
not your face at the same time.
Perfect.
It's a double win.
Yeah, but yeah, before I was rudely interrupted, it was it was saying it's broken through the resistance. Cable has risen above last week's high of 125.50 and also made a daily chart close above that level, so confirms a medium-term bottoming formation. could target back up towards the higher end of the channel, 130. But that's quite a long way off from here. So immediate upside pressure and support level 123.33.
123.33.
Yeah, 123 and a third.
130. Wow.
Yeah. So I mean, big ranges, but he typically smaller size, swing it, that sort of stuff. Don't expect it to go to 130 tomorrow.
Yeah.
So yeah, and I'll
Yen.
some things along the way, but that's the technical pattern. But I mean, it can all get blown out the water, right?
Yeah. 20% tariff on
Exactly.
the UK. Right. We've Euro 104.67. We've got the FTSE down 20 basis points, 87.40.
Yeah, I see that pretty much. We got, 10 points lower yesterday, and then it turned around a bit, back to 87.50, 60. But yeah, you've got this cable going higher. Makes sense, FTSE comes lower, because the only trade in town has been cables, rock bottom. All the money's coming into the FTSE. So this makes sense. First time in 6 weeks. We're seeing some sense out of that.
You like logic, don't you, Peter?
Yeah, well, I like it when it suits my narrative.
Good stuff. Right, so FTSE coming down to earth, and the German DAX. There you go. Take a round of applause if you've managed to survive yesterday. You're still short that DAX, down 40 basis points. Yeah, when I say take a round of applause, that's a hint. It's a cue. So it's been a really tough few days for you guys short the DAX, hoping for those
Ukraine, Russia.
tariffs.
Not tariffs, no, right, okay.
Tariffs to come in. Yeah, Ukraine, Russia.
Yeah, I mean, there was something. I saw something on First Squawk this morning, and this shows you the resilience of the market compared to when things originally kicked off back in 2022, March. There's a note there basically saying Ukraine Zelensky basically says Russian drone attack has struck a radiation shelter on the Chernobyl nuclear power plant overnight. Now,
sorry, what?
Yeah, if you wind yourself back, that would have had a huge, even the tweet would have had a huge impact on the market. Market's done nothing. Now, that was on our tweet deck, right? So if you dig a little deeper into it, that was at 7:15.
Just read it again for people that missed it.
So it basically said here, Ukraine Zelensky says Russian drone attack struck the radiation shelter on Chernobyl nuclear power plant overnight. And then you drill into it a little bit more.
It's called a sarcophagus.
Yeah, and then basically someone said, is this a false flag? Someone said it's reinforced concrete. You need a bunker bomb to do any damage, all this sort of stuff.
That is true.
And then someone came out saying this looks like it never happened. So the power of Twitter. But what I'm saying
he's
is
getting desperate
the
now,
market hasn't done anything, right? So it's whether or not people, I don't know, if they just don't believe what they're seeing, or the market's just generally it's in rally mode, isn't it? Nothing's.
Yeah, it is. It's definitely. Well, FTSE's not. FTSE is coming off further. I managed to visit Chernobyl actually. Back in 2014.
Oh yeah.
Flew into Kiev, and then it's literally just a tourist trip. Jump in the back of a van, and you're taken to Chernobyl. You get the geigometer. Yeah. And you see that it starts beeping.
Yeah.
The closer to the sarcophagus you go. But yeah, the French helped. 2 billion euros they spent putting an additional concrete sarcophagus over the top of it. So there's nothing that we get through it.
You'd like to think.
Yeah, but fight in his corner still.
Yeah. Maybe that's what stunted your growth.
Yeah, that's when the receding hairline started. Good stuff. Right, we're going to go to a quick break. Then we're coming back for some fast markets.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
can find a variety of asset classes on the sidebar menu to the left of your platform. It's now time to pick an asset class. There are 4 major types. 1. Shares in individual companies listed on global stock exchanges. 2. Indices, a group of shares measuring the performance of a particular region, exchange, or sector. 3. Forex, the value of one currency compared to another, like the pound versus the dollar. 4. Commodities, like gold, oil, natural gas, or wheat. Decide which of these markets interest you and which you know the most about. It's up to you to research the market you'd like to trade. This will help inform any trading decisions you make. You need to know the risk of trading a particular market. For example, some markets react to events like economic releases. Next, look at the market's opening hours and how they'll fit into your trading plan. The deal ticket will let you know if a market is open or closed. Lastly, look at the costs and charges applicable. Once you're happy with your market choice, place a deal through the deal ticket.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Are you ambitious? A future leader? Do you think big and raise the bar? If that sounds familiar, IG wants you. We're a global fintech and we offer graduate schemes for the ambitious. You'll see everything as you rotate across the business, building your skills and knowledge as you go. Kickstart your career as a future leader at IG, the home of the ambitious.
Welcome back to Fast Markets. It's that time we're going to look at some stocks, taking your ideas and putting them into our context on how we view the market. But first of all, Pete Ward,
Yes, sir.
on Valentine's.
Yes.
Roses are red, markets can swing. Pete's BMI is the next big thing.
It's coming down.
Is it really? Right, roses are red, his balance is tight, his footsie shorts burning, goodbye to the light.
Nice.
Roses are red, his losses are vast. If Pete was a stock, I'd short him real fast.
Well,
Let's
I'll take
hear
that with
your
performance
own, give us some Valentine's poems on performance, well, my performance this week, dismal. But away from the numbers, asking, can I explain the 230 puts on Legal in General? I'm happy to buy a number of shares. I'll show you the trade in a second. We'll get that up. But that's right. So if I am exercised, if they're below 230 on expiry date, then I would be purchasing the stock. I would receive the stock, not in the IG platform, but because it cash settled. But yes, it would. That's the theory behind it. We will be doing more in our market measures introduction to puts today.
And then I guess the other bit around that is in the event that you don't get the stock put upon you, you will receive the premium.
That's right.
It's a yield play.
So we can go to the screen there. You can see Legal in General 230 put for April. So April expiry, I shorted 30 and the multiplier is 1,000.
Yeah.
In the UK, it's 100 in the US, 1,000 in the UK. So that's 30,000 shares, and I sold them for 4.25 minus the commission. So yeah, that equates.
So I guess just simple terms, it's equivalent of £300 per point, right?
Yeah.
Yeah. So if the stock finishes above 230 by your expiry, you will receive 3.75 times your 300. Which is about, what, £1,100?
Yeah.
And if the stock finishes well below there, you will effectively be given the stock at 230.
230, the way I think of it, I'd buy it at 230 minus 4.25, say. And so that would be, 226 I'd be long stock at. Right, Pete Ward, Fast Markets.
Yes, sir.
I put to you Amazon.
Amazon. Okay.
No, you expected something else there, were you?
No.
Right, Bats was
okay.
shocking yesterday.
So Bats was shocking yesterday. They were off 8%, I think, which is massive for a big, defensive company. They got slapped with an $8 billion fine over in Canada.
Or they took a charge, yeah.
Yeah, well, whatever you want to call it. But basically gave it back all of the gains that they've had so far this year. So they were around 30 quid a share. They went to 34. They finished the day back at 30. Big move for a defensive stock. And it's one that, most people have a little bit of it tucked away.
Yeah.
For, sort of in the event that the markets move against them. But they warned also they've got significant headwinds from Bangladesh and Australian sales. And I noticed that their CEO basically came out, which I thought was really interesting, something I wasn't fully aware of, but they basically said that they want to have, what was the words that he said here? They want to have a, sorry, I've got something in here. They basically want to have a smoke-free world.
That was his first line.
By 2035. Which is massive for a smoking company.
It's a
I know they're
bizarre
pivoting
thing.
towards the sort of the vape side of the world, but
Yeah.
you'd have thought they're heavily reliant on smoking. It's growing.
It's the equivalent of BP coming out and saying, right, we want an oil-free world by 2035.
Yeah.
Which is, that's probably why BP's been such a shocker. Right, you are going to ask me on that stock, aren't you, Pete?
What, Amazon?
No, BP. Right, so BP, we finally found out how big the Elliott stake is. It's 4 billion sterling. So it is a chunky stake. And that is just over 5% of the company. They built it up over a whole year. They've been buying this thing. So Elliott been buying BP for a year. They are not particularly in favor of a breakup. Or which is just as well on Valentine's Day, or a takeover. Mm-hmm. They are in this thing to get on the board and get in there and make sure, potentially removing the chairman. I'd say Murray Auchincloss is kind of on final warnings as well on the 26th of February on the strategy day. But they want to change round BP and one portfolio manager put it as, this is a treasure trove of assets with a swamp of management on top. A treasure trove of assets under a swamp of management. So, so
they're going to do some.
Come on, guys, don't have that up.
They're going to come in and shake things around.
So that's a real. I've got to admit, you got to back Elliott. Right, because if they are meaningful enough in this to take a $4 billion sterling stake, then they mean business. Mm-hmm. So sometimes they just go in relatively small. There's not much they can do, but sometimes they go in big. It's a little bit like the Anglo-American situation, but you'd think that BP would be a little bit easier to turn around.
Yeah. That'd be an interesting one to watch, and it's one that's, I guess, very popular amongst our sort of client base.
So yeah, I would definitely, I'll probably look to sell the 440 puts there. I don't, February 26th should be a catalyst now, and I would imagine the stock could potentially move into that as well. Have to look when the dividends are. Right, we've got some questions here. IWG. I noticed because Pega was short that in her portfolio. Oh no, IWG. Sorry, I was thinking IHG.
What, into work group?
Yeah, do you see this one? Anything on this one?
I don't, to be honest. No, I don't see much on that. I can have a quick look on there.
Yeah, we'll have to come back to you on that one, Andrew. Haven't seen anything. I'll also if Michael Taylor's watching, then I'm sure it could be one that he watches as well. Right, what about Alibaba?
Alibaba, yeah, so they were in the headlines last night. I mean, that stock has just ripped in the last sort of 2 or 3 weeks. It's kind of haunting me a little bit because I was almost pulling the trigger at 95, but just thought, oh, it's been 80 for so long, I'll try and wait and catch it, and it's just not stopped. So they basically came out last night saying that they're going to help Apple integrate its AI for the Chinese market, which is massive, right? Yeah. So not only are they now turning the trend in terms of coming through technically on, going through $100, coming back up towards 120, which last time it was here, it touched it and it capitulated back to 80 again.
It's right at that level,
so,
isn't it?
Yeah, really, really interesting on a technical pattern. Really just interesting in terms of all the stuff that people have been in and holding this, going, this is a monster company. It's got, there's such a huge market out there in China for it. And all of a sudden now you've got Trump in power. He seems more pally with Jinping, and everything seems to be more aligned towards working collaboratively and all that sort of stuff. And then you throw in the classic bazooka of they're going to help with the AI area of this, with Apple, one of the biggest companies in the world, with Chinese market of 1 billion people. It kind of makes a good story, right?
Yeah, definitely does.
So, I mean, let's see. Have we got? I'm trying to see if we've got any sort of estimate on price on those.
Chart off, thank you.
Let's have a look.
Well, we've got, sorry guys, tip ranks there, 121 is the price target. So it's right there. JP Morgan,
that's where it is.
Have 125, Barclays 130. Who's the biggest bull?
Jefferies 150.
Yeah. So Jefferies 150, exactly. That's your biggest bull. And that is Thomas Chong.
Interesting.
The biggest Baba bull.
Yeah.
So
you seen anything in AppLovin?
No. Do we have a look at how that one traded yesterday?
I mean, monster. I mean, I was having a look at it last night. I was on the late covering the US. 775% move last year. Absolutely phenomenal. And then it put 30% on top of its earnings the other day. And so basically mobile advertising, in-game advertising revenue is something that, I mean, I've never even really put my head around it, but they are coining it in, and it's on what they deem to be an extremely sustainable growth metric, which will continue to stand the test of time. So it's like showing its resilience and now starting to really kind of compound, and that move is just monstrous.
Yeah. And to have that big a move after already, rallying from $80 up to 400.
Yeah.
It's just.
Yeah, so it says it's got revenue growth of 75% annually and EBITDA margin of 76%, which remains highly profitable. So it's, but it's one that I noticed in our share flyout, which is sorted by an algo which puts the most popular ones in there.
Right.
Traded by a client base. This was well up there.
Really?
So it's one
good
that's
stuff. I hope the clients are
getting a bit of traction now.
Excellent. Right, and then defense. So it's tricky to know, how the headlines are going to affect. What's the next one? I had some luck. I got hit in Rheinmetall yesterday, but had some luck being short Lockheed Martin. Mm-hmm. This one, look at that move yesterday. So that's exactly what I thought BAE and Rheinmetall were going to do yesterday, and they didn't. They went right back up, but thankfully recouped some of the losses there. And Lockheed, my view on defence is a macro view, that to align budgets better, the US cannot increase their defence spending. Germany's not in a position, right? It has to improve the economy. It can't just suddenly go, yep, there's another 50 billion for defence.
Yeah.
The UK is right at its maximum level. It's got absolutely no budget headroom at all. So in a world where you've got peace in Palestine, you've got peace coming to Ukraine, then you can't afford defense spending, then everybody would love to increase, of course, so they can strengthen their defenses for Europe and whatever, but they can't afford it.
So you think that all these stocks come under pressure?
So I think after a 700% run in Rheinmetall, and I think after BAE Systems has doubled, then it's, we're talking about looking at the next 5 years of earnings growth here.
But then they're talking, they are saying NATO's are going to boost their budgets. They're going to put things up. There was like this Norwegian sovereign wealth fund yesterday talking about the need to basically do kind of ethical investing, but at the same time also need to put a load of money into weapons. They basically said they need to do $1.8 trillion fund, which might consider investing some of it into arms manufacturing.
This is rising
global tensions. So, I mean, it's a difficult one because yes, you've got, you say there's peace in these areas. There isn't really. There's a ceasefire. I'm
looking 6 months down the line.
The world is certainly not in harmony, and a long way from it. And so, yeah, I mean, I know it's a massive bone of contention for lots of people, and lots of people when they look at government spending, they think, well, if this is broken and that's broken and this is broken, why don't we fix that stuff that actually helps people rather than put it onto the defence spend? But it continually gets in more and more investment. And now with the pivot towards AI and things like Palantir, all these sorts of things, they're now going to get government contracts directly from the White House into their sort of AI surveillance. So it's going to change.
Yeah.
The types of weapons will change. The types of tech will change. But I personally don't think the spending will end. I think it'll increase. But
it should be increased on things like, for example, if I was going to attack somebody now, it would be a cyber attack. Why bother
What would you do?
with old-fashioned soldiers and tanks rolling into, what's that?
A mean text?
A mean text. What, a cyber attack?
It's about the limit of your tech capabilities, isn't it?
Yeah, you see the way that I operate the charts in the morning.
That's it.
Right, we've got a real nice one to finish off with. So away from the numbers, Neil has given us a poem for Valentine's Day. Roses are red, Vodafone is cheap, my portfolio's crying, I just want to weep.
Hey, very good.
Was that for me, or was it?
It's tinged with some degree of poking the bear, or the perennial bull when it comes to Vodafone.
Well, no, if I'm short, then I can't be a bull, can I?
I thought you were short puts but long the stock.
Short stock against the puts.
Oh, okay. Fine.
Against being
so
short puts.
You're in a mess.
Because I don't trust Goldman Sachs, funnily enough. Right, that's pretty much us, I think. Yeah, rockets and guns, political politicians will still continue to rattle sabers. That's it. It's all talk.
It's all talk.
All talk. You don't have the checkbook to go and buy a new nuclear submarine. You don't have it. That's why all the ships are getting cancelled around this contract.
Crazy. So yeah, I guess on a lighter note, a little Valentine's joke for you.
Go on.
Why did the skeleton go to the Valentine's party alone?
Tell us.
Because he didn't have the guts to ask someone. There you go. It's coming up with jokes for a 6-year-old.
He's had an hour and 3 minutes to come up with something.
Well, it's better than your
Friday
doom and gloom about missiles and nuclear.
I'm saying peace, baby. Cut defence spending.
No, you're saying there is peace. Well, there isn't.
So yeah, that's it. That's the man that is Pete Ward, the man, the myth, the legend, has done his Friday stint.
That's it.
And coming up next, we have Angeline is just making it into the building. It's 8:35. She had a bit of a lie-in because Fred's obviously on his holidays, isn't he?
So, yeah, I assume she's been wading through all the cards and well wishes and all the flowers that have been sent into her.
Well, that's actually, reception did say to me there's a big pile of cards waiting.
There was nothing.
Yeah. So the receptionist handed me a pile of cards earlier. I'm thinking, oh, brilliant. Yeah. No, they're all for Angeline.
Brilliant.
Right, go to break and we'll be back in 5. But stick around for our market measures, the beginner's guide to options. We did calls yesterday. We're doing puts later on today. And we'll also, on Monday, we'll go over them both again with a treat, a special guest. The man that I learned options from in 2005 is coming in for me to interview him.
Oh, nice.
Imran Laka will be with us on Monday.
Brilliant.
And yeah, he was the options guru at Credit Suisse that was stolen away. I can't remember if it was Deutsche or Citigroup that stole him away.
And you managed. Well, so he's coming in to chat.
Everything options.
Excellent.
And he's going to do a market measures with me. So,
Cool.
right, we're going to break. And
Are
keep
you
working.
ambitious? A future leader? Do you think big and raise the bar? If that sounds familiar, IG wants you. We're a global fintech and we offer graduate schemes for the ambitious. You'll see everything as you rotate across the business, building your skills and knowledge as you go. Kickstart your career as a future leader at IG, the home of the ambitious.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
You can find a variety of asset classes on the sidebar menu to the left of your platform. It's now time to pick an asset class. There are 4 major types. 1. Shares in individual companies listed on global stock exchanges. 2. Indices, a group of shares measuring the performance of a particular region, exchange, or sector. 3. Forex, the value of one currency compared to another, like the pound versus the dollar. 4. Commodities, like gold, oil, natural gas, or wheat. Decide which of these markets interest you and which you know the most about. It's up to you to research the market you'd like to trade. This will help inform any trading decisions you make. You need to know the risk of trading a particular market. For example, some markets react to events like economic releases. Next, look at the market's opening hours and how they'll fit into your trading plan. The deal ticket will let you know if a market is open or closed. Lastly, look at the costs and charges applicable. Once you're happy with your market choice, place a deal through the deal ticket.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer 2 ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Hello, welcome to the show. This is Trade Expectations with myself and Chris Beauchamp. Thank you so much for joining us on Valentine's Day.
Is it?
You
Oh,
getting
okay.
you getting your wife Hermes then? Given that, yeah.
No, we don't do it. We don't do it.
You don't do any
It's
of
a
it.
great money saving exercise.
It
No,
is a
not
great
thing.
money saving exercise. I mean, I saw some of the prices on the high street and on the way in. It was like Valentine's brunch for two, and it just looked like smashed avocado with some weird things on this, and 2 small flutes of champagne. It was like £56 for smashed avocado on toast and
To see
2
people coming, it's painful.
flutes of champagne. I left a cheesy card. That was it. I ran out of ideas and left a cheesy card with a box of chocolates on the worktop this morning before heading in. And what a crazy day it is. Let's have a look at Hermes. We're still a ways yet, trader friends. Let us know on the chat on my left how you're celebrating, if you celebrate at all, or you're like Chris Beauchamp and does not do Valentine's. But let's have a look at Hermes because it has come off slightly, but it's still up 2.5% there. One that you like, Chris? This is certainly one that I like.
It's not one I'm a massive follower. I know luxury has not had the greatest time of it, but look at that bounce. That's crazy. That really is quite the maddest thing I've seen. It's incredible, really. I mean, we're up 45% in the space of 3 or 4 months. Is that China? Where's that come from? I'm trying to work out I looked at the CAC this morning and it's merrily making its way to fresh record highs. So obviously there's part of the power there is Hermes and these are the luxury stocks. Really very, very impressive. And it's incredible how the CAC has staged this turnaround really, and it's just not looked back. And the concerns about France have disappeared for the time being. And so there's all this noise about the DAX record highs, but look at the recovery in the CAC. It's just incredible. It's the most sustained upside we've had since late 2023, really.
Yeah.
So fantastic performance.
It is fantastic and very much like the DAX. I mean, we're talking about this for the last few weeks now. You know, is this like a real recalibration of the hunt for stocks elsewhere other than the US at the moment? And
Don't say it. Don't say, is it time to buy Europe? Because every time someone always has to write this thing, is it time to buy Europe?
Yeah.
And it's not really been, but you can't argue with the DAX at record high.
Yeah, let's have a look at it today. I mean, you know, it's
Late to the party, I mean. Well, I think you would be late to the party now if you're buying it now, really. I mean, look at what happened. Sorry, to go back in time to October 23. We had a huge rally there in the DAX from 14 to 16, and then it went sideways for about 2 months. So just be aware of that, because that's what we forget. We look back at these fantastic moves higher, and we think, well, it's got to continue. It might do, but it also might, like we saw with the FTSE last year, go sideways for an extended period. So there's always that risk to bear in mind.
There's also this risk of now, I mean, very real risk. We talked about this yesterday, that the, Fed is seen on hold now until September.
Yeah, but from the week's price action, the market doesn't seem to care. I think what would spook markets is if they talked about hiking. But yes, we had stronger CPI, stronger PPI this week, double whammy on the inflation front. And yet the response was, meh, okay. Because the components of PPI, particularly that feed into, and here I'm going to give you a Valentine's Day present by talking about PCE, which is that
Your
thing that
favorite.
everyone's supposed to care
I thought
about,
you
but
didn't
nobody
care
should.
about PCE.
I don't, but but the reason why the market was so sanguine about yesterday's PPI reading was because the components that feed into the PCE reading weren't particularly strong. And they weren't showing the same kind of picture that Wednesday's headline inflation and indeed core inflation figures did. And so there's an argument made that because, again, PC is the one the Fed actually looks at, even if it's the one that nobody cares about, it means that hasn't really shifted the chances of a rate hike from the Fed. So what we're talking about now is how long will they stay on hold? Markets are comfortable with that. I think even at these highs, markets can live with that. That's the lesson of 23 and 24, is that markets can live without rate cuts as well, because the Fed didn't cut rates as quickly as expected in 23 and certainly in 2024 either. So as long as they don't talk about hiking, maybe we can park the inflation issue for the time being. And as I say, the fact that, yes, you had hotter readings on the headline figures of CPI and PPI, but if you looked at the components that go into the Fed's preferred measure, they weren't as strong. And so the concern wasn't there. And that's why US stocks, part one of the reasons why US stocks had an absolutely stonking day yesterday.
Yeah, and that's why the status quo remains. I guess the big thing here is at which point we might see these reciprocal tariffs. I mean, I'm hearing across the board from many of my mates from Bloomberg, Reuters, anytime today, if history repeats itself, it might be later after dinner time, London time, because he tends to kind of make those announcements then, or it tends to trickle out after dinner time here in the UK. You hearing anything more from this front about what form they might take?
Well, again, yes, the point I think wasn't almost the form they're going to take. It's the fact that they are not coming in immediately. And what we've seen over the past 2 weeks is, he's serious about tariffs. Actually, I think what we've seen is he's serious about negotiating.
Yes.
With Canada, it was tariffs now. Actually, not tariffs now. We'll delay
we'll
by a
roll
month
that
after
back.
a phone call. Yeah, we'll have a phone call and then we'll maybe have a chat. And with the European Union as well, it's a negotiating tactic. That's what it seems to be. On current evidence, that's what it seems to be. That he's not saying they're coming in now. I'm putting a marker down that they will come if people don't come to Washington and have a chat. You had Modi in this week talking in Washington, agreeing to expand trade with the US. You've got Taiwan saying, Trump was talking about tariffs and Taiwan and what the awful things they've done to the US ship industry by being so naughtily competitive and making money. How dare they adopt this American model of capitalism and do it so well? But they've taken US chip industry. So obviously Taiwan will go to Washington to buy more stuff, especially defense stuff, which will keep him happy. So you can expect a similar thing from Canada, Mexico, Europe, China probably as well, although China might be a bit of a tougher ask on the negotiating front. But this is what we've got. And this is why the market is so sanguine about it. So the two big things that spook this market are inflation and tariffs. And this week has shown you that actually there are reasons, if you look past the nasty headlines, and of course it is Trump, so headlines are his game, because by the time people have reacted, he's moved on. But if you look past the headlines, that's why the initial reaction isn't always the correct one. And that's why you had that drop on the tariff news and then the rebound, and then we've slowly clawed our way back in terms of market price action.
That's right. And let's get our viewers across some of the Valentine's Day headlines. We are awaiting more reciprocal tariffs from announcements from Trump. But as Chris rightly said, it's watch for that rollback, or it tends to, in the last few weeks, we've seen a lot of saber rattling, and then he pulls back and says, we're going to hang 10. Trump, I think the more interesting thing is, sources saying that he's going to change the US CHIPS Act conditions. This is could provide some delays to some of the upcoming chip disbursement. So pay attention to that, because for you guys, trader friends, that have exposure to any chip stocks, this could actually rock the markets. I'm actually paying more attention to this than the tariffs. The funniest thing I saw overnight, Chris, was did you see that story about Google now not allowing anyone to make a complaint about the Gulf of Mexico?
Well, can you imagine how many emails they're going to get?
Yeah, they're just taking off that function altogether. Just
So you could before complain about something on the map?
Yes, you could. You could complain and give feedback about changes, but they've just completely taken the function off.
Oh, that's interesting. I'm disappointed I didn't know that before, because you complain about things I don't know. What controversial things could you complain about? Let's not do that on live.
Let's not talk about that. Let's talk as well. About Reddit doing the same thing, but yeah, that's another discussion altogether. And after those PPI prices, it's going to be a really key week coming up on the macro front. And ahead of that, we also have retail sales data for January. I'm looking out for core retail sales to still be quite strong over there, despite everything that's going on. I just have this feeling that anything, I was talking to SR about this, anything that has been touched by a human being over there is going to be very expensive. Their actual goods itself, cheap, still affordable, but services is so hot at the moment. I think this is going to push up that figure on the core front.
Yeah, I think that's the thing to watch for in those numbers, really, for the US. And then next week, of course, you've got UK data as well. So you've got unemployment, CPI as well. Have we got CPI from the UK next week? Yes, we do. 2.5% was the last one, so that's interesting. And retail sales in the UK. And then crucially as well, you've got the RBA cutting rates again down to 4.1. This is expected anyway. Now 25 basis point cut from them. So continue to ease policy there, which is really interesting. That everyone else is still happily cutting rates, well, apart from the Bank of Japan, and the Fed is holding things fairly steady. But it's an interesting week for FX markets, really. But then a lot of strength in the dollar maybe is poised to come out a little bit because of the tariffs not living up to expectations. With this morning, it's nearly a 2 month low in the US dollar. Continues to unwind from the sort of tariff euphoria of mid-January, the inauguration euphoria, if you can call it that, for the dollar.
I am really annoyed by that, actually. I'm just put up this dollar because I did have a short dollar after January, and I thought, we're going to see these tariff concerns, ease off and not be as bad as possible. I should have kept it on because I took it off after, I think it was the first or second week of January, but I should have kept it on. The other thing is we've got Moderna also coming out with some earnings prior to that. But you're right, we've got that UK number. RBA, to be fair, they've always been ahead of the game, haven't they? I feel like they've always been ahead of the cycle.
I think that's fair, although they were dealing, of course, not so long ago with what they feared was persistent inflation. So they're a rather late convert this time around to the cause of cutting rates. But as ever with Australians, when they get doing something to do it with vigor, with a passion, really, exactly, yes, the Antipodean cousins like to do this in a more interesting way than we do, really. So that's a very interesting one to watch and see what the commentary around there is, because it certainly marks a shift in policy for them, really, from where we were a year ago or so. So an interesting one to watch in a week where, of course, it's less blockbuster next week. Can I say that? Fewer blockbuster? No, less blockbuster in terms of
fewer blockbusters.
Data. Fewer blockbuster. No, correct term, please. We've got Fed minutes as well, and I think Bailey's speaking, but it's not quite the same. Where we had the big beast of CPI and PPI in the US this week. So again, it's a tariff watch, really, particularly.
Yeah. And on top of all that, I feel like we've got FOMC minutes as well.
Yeah, we do.
Yeah, Wednesday.
So. But those, again, Powell's comments obviously we've had Powell speaking in his testimony after that. So after the Fed meeting, said they won't give us that much, I don't think, in terms of excitement. I don't mean to pour cold water on it, but I suspect it's a case of we've heard Powell literally around the CPI data itself. He was talking to Congress.
Yeah.
And we're making the right kind of progress on inflation. So I don't expect too many fireworks.
Probably the data dependent. We're going to keep an eye on, wait and see continuation. But in terms
Let's make central banking boring again. I think that's the most important thing, really. That's what we'd like.
It certainly has been exciting the last year or so. Taking a look at cable at the moment, we're still, in that sideways channel. Let's have the daily chart up for you to give you a better idea there. We have just slightly broken out, on the top. But if you are trading cable, Axel is going to come on a bit later to talk about his latest analysis. Well supported and by his technicals, it's going to potentially head towards that 1.3 mark there. Views on cable, Chris?
Well, it is interesting, isn't it? You've got markets can be so delightfully perverse, can't they? Because you've got the pound at its highest level since late December, just as the BOE seems to be tipping itself into a more dramatic cutting regime. So it's one of those things that analysts say it's more dollar weakness than sterling strength, because that seems to be what's driving it. Is that it's the fall in the dollar rather than a sudden love for sterling, given the fact that we're expecting more rate cuts in the UK. That's interesting. So that it's still in a downtrend, but it's really had an impressive rebound from those lows. One to watch really, back above 126. Not trying to preempt Axel here, but there's quite a bit, I think, more of resistance coming through 127, 128. We're one to watch there really, because it's been a one-way move, and we've not had a decent rebound in these trends. And that's what you want to see in any trend. If an uptrend, you want to see the occasional decent pullback. Downtrend, you want the occasional decent rally. And maybe this is what we're going through right now into the next BOE meeting. One to keep an eye on, I think, particularly.
Amazing. And for those of you trading cable, we'll have Axel with us after this to talk a bit more about what he is seeing in the coming week. Cable breaking through resistance, immediate upside pressure, according to his analysis, should be maintained, while Tuesday's low of $1.23 underpins. Right, we have how many more minutes left, Caleb?
Are you trying to get rid of me?
I'm not trying to get rid of you. I am trying to figure out. We've got so much stuff to cover. NatWest, how much time?
NatWest is going to say we've not covered NatWest.
Yeah, do you bank with NatWest? I got one of my ISAs with them.
I do, and my dad bank is again classic. My dad banked with NatWest, so therefore I bank with NatWest. It's that line about you're more likely to get divorced than change your bank.
Exactly. Yeah. Also, did you get suckered in by the university mug? Because I bank with Barclays because I got suckered in to that university mug. When they. No,
I was there before I went. I was NatWest from about 11. So there you go.
All right. Okay.
When it was still National Westminster, that's how long I've been with them. Anyway, I think if I was NatWest, I'd be very happy with the results in terms of the share price performance, because you had Barclays yesterday got absolutely whacked. Mm-hmm. And yet NatWest is morning down about 1% or so, is it?
Yeah.
I checked a second ago. So that's a reasonable reaction for a share price that has had an absolutely barnstorming, absolute stormer. It was the best performer on the FTSE 350 last year. One of the best, certainly. And it's not often a big UK bank delivers that kind of performance. So an absolutely stellar year for NatWest. I'm not sure. There are not enough superlatives to describe NatWest, and that's not something you've been able to say about banks for a very long time, at least not in a good way. They've been egregious, but not in a good way. So yes, I think the numbers are fairly good. There's plenty of potential for the year ahead, and it's the resilience of these names, even with, again, the Bank of England shifting towards more dramatic rate cuts. Aspect is the key thing to watch, because yes, it will hurt their profitability on the interest margins. I got an email from this week saying that their rates are coming down for savers. Mm-hmm. Funnily enough, the one for the credit card hasn't yet arrived, but there's some surprise, isn't it?
Yes.
Funny that. But anyway, so I think there's a little bit of profit taking. Again, not to be your classic analyst, this is profit taking, but it probably is, because you've had such a fantastic run for the shares. We were down below 200 pence a share.
Such a good run.
Absolute. Yeah, and it had a bit of a pullback in early January, and then it came storming back. So now the good news is in the price. Maybe we can expect it just to consolidate for some short term, but it looks reasonably well positioned for a UK high street bank. These are a good set of numbers.
Yeah. So NatWest, just getting you guys across whilst I bring up my all sessions list. Its stock price, as Chris rightly said, has been on a tear, up more than 100% the last 12 months. So today could be a bit of profit taking there on the back of its strong numbers. And we are just seconds away from the opening. So I wasn't trying to get you to go. I was trying to figure out how much time we had before this. Do we have to go for Sting? Right. There you go. Caleb and I are telepathic now. Here we are, all sessions, and I am going to put up my chart. Chris, do you want to read us through the winners list first?
Oh, hang on.
Can you?
Can't see.
Oh, don't worry. I'll go through the winners. You do the losers. Airbnb up there at 14.6%. GameStop up 8.7%, and we have a lot of the Chinese online names there. The JD.com, PD, Pinduoduo as well, up 3.6%. Moderna. 2.7% higher. Moderna, of course, coming out with results, I believe, later today. Let's have a look there. One of the ones that I really always favor or keep an eye out for because it has such a quirky ticker, mRNA. It's expected to post Q4 results before the markets open, cash market rather. Look out for any comments about spending, cutting spending as well. And to also any comments about the adoption of its virus vaccine for respiratory diseases. Any of those names jump out at you, Chris?
Well, it's only Airbnb top of the list. Did the earnings last night from them, I think? He says. I'm not as across this as I should have been. Yes, a stellar performance. Maybe they're up on the Ukraine deal. Who knows?
Yeah,
best expected earnings. Yes, I was. There you go. I was right. It was a good guess from me.
Higher quarterly
soft
revenue.
Guidance, though.
I have to say, I'm not a fan of Airbnb. I know that Pete Wardy was saying just now that he uses it, loves it. Richie Rich was, or Rich T Biscuit was saying that he sometimes, has these big dues. But I have an issue with the business model, and that is my next door neighbor rented it out to 4 people. Probably it was rich, and then 40 to 50 turned up, and he was in his second home somewhere in Spain when all the neighbors called up to say, not only are cars coming by the hour to drop people off, but they all seem to be adults, and they all seem to be either smelling interesting, or they have lots of balloons. And our road became littered with cylinders. And by which point my neighbor was calling back from Spain because all the neighbors had alerted him to it, to say, can you go over, Ange, to find out what's going on, and if there are, people there. I mean, they were all spilling out, to the garden, the house and everything. And I thought, no.
That is the risk.
And he called the police. He called the police, and the police told him that we can't evict people from your house if you invited them in. So I have a problem with the business model because I just think that all well and good. So I don't know, as a matter of principle, I don't use them because I have a problem. We've
used them, and not only do we've done really well. I have to say we've also got excellent reviews for the places we've stayed in terms of as guests. They said how we always leave it in a nice clean state and all this kind of thing. So we've liked it, I think. But there is the risk, of course. And of course, you've got things like Barcelona where they banned it entirely now, or have they cracked down on it? Certainly. And it was Paris as well, wasn't it? That said we don't like Airbnb because it's crowding out people who actually want to live here. So that is, those issues aside, looking just at the numbers, it's doing really very well. I think very, very a decent set of numbers there from Airbnb.
No, certainly caught those investors, and they certainly agree with you because it's up almost 13.7% now.
Shorts have been caught napping, if you like. There we go.
Yeah. Okay, let's have a look at some of the others. Let's have a look at HIMS because RSAX, thank you so much for points. I thought I had it on my all sessions, but HIMS and Hers, one that I've been talking about a lot after the Super Bowl because they had that crazy advert. If you haven't seen it, trader friends, do have a look at it. Tell me what you think because, you know, it is highly controversial given this company has made such grounds into this space, even when they haven't had, you know, the full sort of FDA blessing. Let's have a look at the daily chart here. It is climbing higher, up almost 4% there, and edging higher there. They sell, of course, the telemedicine company and online as well, selling these supplements that apparently help you lose weight. Chris, have you seen that advert or during Super Bowl? And have you started seeing these? They're starting to have these billboards in our tubes as well.
Doing the Super what?
The Super Bowl.
Super Bowl? What is the Super Bowl? Is it some kind of sport that people watch? I'm joking. I have no idea. I've not seen it because I had no interest at all on a Sunday night. But watching the Super Bowl. Sorry about that. But
it's the obesity and diabetes play. And there are many out there that think HIMS and Hers will be soon encroaching or already encroaching on the Novo Nordisks and the Eli Lillys, you know, the people that own the space. Speaking to our trader friends who are all very engaged here, Krish Dharmawan, hello from Sydney, New South Wales. I hope you are having a great time and listening to this on Manly Beach and hopefully having, well, it might be quite late right now, but they do have some really nice pubs and bars there. I did my bachelor's in Australia, so I have a firm place in my heart for that part of the world. Also, RSAX, yes, I have seen HIMS. I think it's in my all sessions, but for some reason it didn't show up. And we've got Bitcoin Trader also chiming in there. Away from the numbers, saying, any thoughts on MNG as a buy and hold for income? I quite like MNG as a hold for income. Any thoughts, Chris Beauchamp?
Yes, I think it's not a bad performer of an income front, really. Again, these kind of asset managers, that kind of thing, they provide quite a decent set of income. Really, I know, 9% yield's a bit mad, really, but Legal in general, that's another very solid one. Good performance from them. I know Rich was talking about them yesterday. So in the world where we're likely to see maybe rates come down a touch and put some pressure on bank savings accounts, M&G, interesting one to watch, and 9%. I mean, what about the share price? Yeah, not so great share price performance, but it was fairly sideways since 2021. Okay, so holding steady at best.
Yeah.
But you are getting a very chunky dividend yield of 9%.
North of 9%. That's really, really very good. And, don't forget, trader friends, you could take a look at this chart immediately. I think, well, option strategy, if you're going to trade this. Bigger beers. I took a leap in HIMS. And we had the deep seek dive up 150%, and it's already up money. Well done, you. Gonna hold this for a while. Love that bigger BS. We need to get Andy Gavin back on because he is really into leaps here. And I believe I'm right in saying, if you're watching this, Andy, correct me if I'm wrong, that he has taken a leap in Palantir as well. He has a rather large holding in Palantir. But is trying to diversify that holding through options. Terence, come again? 90 seconds till break, I'm being told, before they come in with the crook. Right. Let's have a look at the indices right now and get us across that. For those of you that are just tuning in, we are having pretty much a mixed day. The US Tech 100 up slightly there. Germany 40 though down slightly, but could be forgiven. It's been such a stellar performer, both the DAX and the FTSE. Chris, do you think this stellar performance will continue next week?
I knew you'd ask me this. But poor FTSE's having a bit of a miserable day. I think the DAX, if you're already long it, fine. I mean, the question has to be asked, how long do you start wondering? But if you're not in it yet, I wouldn't be jumping in right now, which is not an invitation to go short. I think it's gone a long way. I think it's the one just to keep on your list for when it has a nice pullback, because that's more interesting. Look, the Hang Seng as well, that's the other one. That's come storming back, and we've talked about that before. But finally, as ever with markets, when we were talking about stimulus in China, nothing, no sustained rally. Nobody was looking at it. There we go. Turn your back on it for a second, and we're back at the highest level since 8th of October last year.
Yeah.
There, so absolute stormer.
And also the interesting thing about the Hang Seng, same as the MSCI as well. Yeah, turn your back on it, and then suddenly it's back at those levels. But what's interesting too is that China is they're a bit like Trump on the stimulus front, aren't they? They say they're going to do something really big, like a bazooka, and then roll back, and then we're going to do something sustained. Oh no, it was just a blip.
But what this proves is they didn't need a massive bit of stimulus to drive the market higher. That's the headlines aren't the important thing; it's the fundamentals, and they appear to have finally shifted. As ever, the market likes the Hang Seng once again in a way it hasn't done for a while.
Yeah. So, Chris, that's all the time we have right now. Just a quick. Oil prices rising slightly. We just talked about the markets there. DAX storming. No one really knows how long this might continue, if we're honest. But Rich is kind of like it's
on a postcard.
time. Yes. What's the rest of your day looking like, Chris?
Fairly quiet, I think. For meetings, gentle wind down. Hopefully, no more tariff announcements. That's the plan.
It's going to be Sunday night, as per usual. On that note, have a great weekend, and we will see you on Monday.
Are you ambitious? A future leader? Do you think big and raise the bar? If that sounds familiar, IG wants you. We're a global fintech, and we offer graduate schemes for the ambitious. You'll see everything as you rotate across the business, building your skills and knowledge as you go. Kickstart your career as a future leader at IG, the home of the ambitious.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
You can find a variety of asset classes on the sidebar menu to the left of your platform. It's now time to pick an asset class. There are 4 major types. 1. Shares in individual companies listed on global stock exchanges. 2. Indices, a group of shares measuring the performance of a particular region, exchange, or sector. 3. Forex, the value of one currency compared to another, like the pound versus the dollar. 4. Commodities, like gold, oil, natural gas, or wheat. Decide which of these markets interest you and which you know the most about. It's up to you to research the market you'd like to trade. This will help inform any trading decisions you make. You need to know the risk of trading a particular market. For example, some markets react to events like economic releases. Next, look at the market's opening hours and how they'll fit into your trading plan. The deal ticket will let you know if a market is open or closed. Lastly, look at the costs and charges applicable. Once you're happy with your market choice, place a deal through the deal ticket.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction. Whether prices are rising, falling, or staying flat, there's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Are you ambitious? A future leader? Do you think big and raise the bar? If that sounds familiar, IG wants you. We're a global fintech and we offer graduate schemes for the ambitious. You'll see everything as you rotate across the business, building your skills and knowledge as you go. Kickstart your career as a future leader at IG, the home of the ambitious.
Hi, Axel. Welcome to Live from the Trade Desk with our one and only Axel Rudolph. That's cue for the applause, people. I think it works. It works. It's great. We've got all these cool buttons now with sound effects that have finally come through. Plus, trader friends, if you haven't noticed, also that wonderful, those boxes on the side so that you can see me, not very elegantly, trying to get the chart price up and also zooming in live. Axel, how is your Valentine's Day? Chris does not do Valentine's. Do you?
I have to.
Otherwise, it's.
Yep. So
tell us, what are you up to today then?
Today, but I have no idea. I'll work first of all, and then once that's out of the way, maybe cook a nice meal, and then we'll take it from there. But we're definitely not going to go out. That's for sure.
Let's have a look at the FTSE. Slow start here so far, a bit like my Valentine's Day. Slow start here so far, but we have had a bit of a lift in Paris due to Hermes on the CAC 40. But if we're looking at the FTSE itself and you're trading that, it's a bit of a slow start to the morning. The trade policy uncertainty, of course, continuing to hang over equities. What do you see for this session for the FTSE and perhaps the week ahead?
Well, if we take a look at my chart, I mean, what I find kind of interesting is that because of yesterday's results by a few companies in the UK, which were a bit disappointing, the FTSE did not keep to its record high it made earlier in the morning, as the DAX 40 did in Germany, for example, but we can look at that one later. So for me, for all those people who are short the FTSE, I know there are a lot of you out there, it may become less painful. Why am I saying that? Well, basically, as you can see, What we formed yesterday on this daily financial bed is called a bearish engulfing pattern on the daily candlestick chart. And what that is, let me just make it bigger, is that what you've done is you've engulfed
Here we are. Let's have a go now on
Let's
to
try it for the
Axel's
third time.
charts. Third time lucky.
Yay!
Here
We've
we
made
are.
it. So yeah, sorry about this, everyone. What I was explaining, and I'm doing that for the third time now, this is the FTSE daily chart, and this candle here is called a bearish engulfing candle. So the difference between the close and the open, and as we saw yesterday, the close was below the open, that formed this red candle. And that candle engulfed the previous bullish candle where we had the close above the open, the green one. So if you were to take this red one here and move it to the left, that would completely cover basically Wednesday's upside, and that is actually negative. But the pattern actually gets confirmed if we were to fall through Thursday's low at 8,828. So if that were to happen today, it would confirm this toppish formation, and the next downside target would be our previous high here, going back to the late January high at 8,693. So I wouldn't be surprised personally if the FTSE were to slip in the next few days back towards 8,700, and then we'll have to see what it does there. But short term, the FTSE looks toppish to me, which is not the case for this chart, which is the British pound against the US dollar. And what I'm seeing here is perhaps a major trend reversal, and nobody's talking about it yet, but the FTSE is not looking great, but cable, so the British pound against the US dollar, is. Why? Okay, can you see these previous highs here going back to late January and also early February? What we've managed to do now is to break above these highs, and for the first time in a month, close above these highs yesterday on a 5 p.m. New York close. I think we've got an issue again on the screen.
I think your screen's frozen, so they're taking mine.
So, but which one have you got on there? Yes, cable. So,
yes.
Okay. Let me just share mine again to try and get it back. But let me talk about yours. Basically, if you zoom out a little bit, Angeline, you can see that we are now in the process of breaking above these previous highs going back to a late December. And that, if that were to happen on a Friday closing basis, and I think for me the level is 126.07, then for me we formed a major medium-term reversal to the upside. So let's see where we close later on today. The level I'm watching out for is 126.07 on the British pound against the US dollar chart. And once that is taken out, for me, that is a major reversal to the upside. So interesting, because nobody's talking about it. Everybody's still thinking cable's going to go to 120, but it looks as if technically at least we have a reversal taking shape here. And if that were to happen, we could easily go back towards 130 and probably even higher than that. And you will have heard it here first. Now, I'm not saying this is going to be the case, but technically it looks to me like that. And this view, for me at least, will be in place as long as Tuesday's low from this week, which was made at 123.32, isn't taken out. So further upside to be seen probably with regards to cable.
Phew, loving the fact that our lines align, thankfully. We'll try and get your charts up again, but let's have a look at Australia now, because Chris and I were talking about the RBA recently, about the RBA always being ahead of the game, and whilst the rest of the world central banks, are possibly even now Fed, it's hold. If there's any move from the Fed, it's probably summer or even September, according to some surveys. RBA, at the antipodeans, we're seeing that potentially we could have RBA at least cutting rates by a quarter point to about 4.1% at the coming meeting. At least that is the expectation. Let's have a look at that. How are your charts? Are they working now, Axel?
I don't know. I'll have to ask the gallery. They're not working. Okay, so I need yours again. Okay, so I don't understand what's going on here.
Aussie dollar versus the US dollar first.
Yes.
This is daily chart
and
here.
You can see here on this chart, we have the same pattern as the cable chart we just looked at, in that we are now rising, and it looks as if we can potentially today close above the 24th of January high. So that high, go back to the left, 24th of January high is above that 24th of January high there, exactly. That would mean on a Friday, because it's Friday today, on a weekly close, the end of the day, end of the week, if that is above that high, again, we're forming a bullish medium-term reversal pattern because we're bottoming out here as a sort of saucer bottom. And that could potentially be very bullish for the Australian dollar. Now, that might not tie in with the view of the central bank cutting rates, but technically speaking, it looks as if we are bottoming out here, and if further Australian dollar strength is going to be seen versus the US dollar, and that could take us back up again towards the 66 area. So again, for readers of my daily FX technicals that I send out at 7:30 every morning, we've been long the Australian dollar, I think, for the last 2 weeks, and same for cable and same for euro dollar, etc. So we're seeing these reversals, and if you get confirmation on multiple different markets, it is telling you something that you might not just spot on one of those. So it's always good to look, for example, at cable and the Australian dollar and euro dollar to see whether they line up or not. And it tells me the US dollar story is not as bullish as a lot of people think it still is.
Let's take a look at the euro dollar, speaking of which, because that's also interesting given we have minutes midweek coming up. Here's my chart.
Yeah.
This is a daily chart.
So here we are not quite there yet. We're heading towards this 27th of January high, that high on your chart. And basically we are exactly that one. No, the 1-2 to the right, that high. Yep. Once that's taken out on a closing basis, we might not be able to do that today, and that level's 105.33. We have the same pattern again that we've just seen on the Australian dollar versus the US dollar and the British pound against the US dollar. If that happens, again, we could see a major reversal, which could take us back up towards the 108, maybe even 110 area on euro dollar. So I'm watching these levels very closely. The euro is lagging the British pound and the Australian dollar, but it seems to be heading in the same direction, and we're on track at the moment for a fourth consecutive day of gains, despite all this kerfuffle to do with Trump tariffs and then, delays to the tariffs and this and that and so forth. Because the more we hear this, the more the market seems to be prepared for Donald Trump threatening something and then giving other countries time to react to his threats and then sorting it out later. So for the time being, the impact every time we see, and we saw that last night as well when his comments came out and his tweets came out, seem to be lesser and lesser. And perhaps for that reason, the US dollar is no longer as strong as it was, a few weeks ago. Every time we had something come out with regards to tariffs, it would really strengthen. This is no longer the case at the moment.
Some questions coming through thick and fast here. Thanks very much, trader friends, for chiming in. We've got Neil saying the long euro trade of the week looks a good call. Jugger saying, Axel's mouse cursor, is it moving? Yes, Jugger. It's because, unfortunately, something is up with Axel's screen sharing at the moment, so we're using my screens, but thankfully even the euro dollar golden lines there are very handily lining up with what Axel is talking about. We have Neil also asking if we have, can we show gold? Here we are, gold 3,000, 50-50 is his question.
I don't know. I have a target at 3,000, and let me just get my gold chart up here. You can show yours because obviously mine is not working. But yes, we've got the high seen from Tuesday, and we are in the process of trying to break through that, as you can see here. Basically, 3,000 for me is an upside target, and then above that, I've got another one at 3,100. But yeah, stay long gold. I mean, I've been long gold for years, from 1,100 and something, I think. And the trend's your friend. Don't sell into something that's going up because it's likely to go higher. What's behind this move? Well, we've been saying it's central bank buying. The Bank of China keeps on buying gold, and a lot of other central banks do so as well, because they want to perhaps in the future at some stage have the flexibility of moving away from the US dollar, and therefore they buy gold. And also all these recent spikes in US inflation, CPI coming higher by 0.1%, not just on a year-on-year basis and month-on-month basis, but also with regards to core inflation, and yesterday's PPI data also being higher than expected. all of these inflationary pressures basically lead to investors buying gold as a safe haven, and you can see that reflected in the price here. So yes, 3,000 is first of all my target, not 3,050. Why? Because 3,000 is a psychological round number, and investors quite often are drawn towards these, but then around these round numbers you can often get resistance because they're round numbers, people remember them, and you know, sometimes markets don't quite reach them. They go to 2,995 or something like that. So I don't know where you got the 3,050 target from, but longer term, yes, definitely. Short term, we may struggle around the 3,000 mark.
And if Ronnie and Rich are listening in on this, they will both be probably screaming outside because, or at home if Ronnie is working from home today, because they have an ongoing bet. Axel, you aware of their bet?
I can't really remember what it was.
So correct me if I've got this right, trader friends, but Ronnie is saying 3,000 by midsummer, is that right? No? By
it's going to be ahead in the next week or
April
so.
2nd, and someone else is saying 3,000 by midsummer?
Yeah. I mean, look at the chart, and look, we've gone up, what, over $100 in the last 3 days, and we are now sort of $65 away from 3,000. So I'd be very surprised if it happens by the summer. Unless it goes, as I just said, to 2,995 or 96, 97, and doesn't quite hit 3,000. What I do know, though, is a few of our colleagues at IG have also looked at the gold price, and you know, we've been talking about it, and they bought it. And they thought they bought it at the high around the late January highs, but look
at where
they've made another
now.
what, $200.
Yeah.
So yeah, the trend's your friend.
The trend is your friend.
Can't stress that enough.
Blake 7 saying, I guess Axel's just answered your question, Blake 7. So would you jump in now for the long term?
What it depends on the risk to reward. Let's just look at it. I mean, if we go long now, let's say 2,937, then we have an upside target, let's say at 2,997. So we're making potentially $60 because we think perhaps it's going to struggle around the 3,000 mark. So if we want to get $60 as a profit, my personal way of trading would be, well, in that case, I'm not willing to risk more than $30 to the downside because I want a 2-to-1 risk-reward ratio. Now here, where's my stop? My stop is the last reaction low. That's the low we saw basically back a few days ago on Wednesday, and that was 2,899. So that is actually $40. No, its low is 2,864. So we're talking $70 to the downside for an upside target of $60. So personally, I wouldn't jump in here now, no, because my risk is bigger than my reward. If you trade though on a shorter term time frame, if you go, for example, on a let's say 15-minute chart, Angeline,
here we go.
You can see that short term we might be topping out here a little bit because we've got a series of 3 higher highs. But if you look at the relative strength index, which probably you don't have on your chart, but I have on mine, that's showing triple negative divergence. So you may get an opportunity for the gold price to come back down again short term and go back towards 2,930 or so, and maybe a little bit lower, in which case you could then go in perhaps. But basically it's all about risk reward. If I were trading on a 15-minute chart now, my stop would probably be the low from 345 this morning. That's about 2,923. So if that's your stop, let's say you go long at 32 or 33, that's 10 points that you're risking. And if daily chart, that could work, but yes, I wouldn't do it on the daily chart with the with the low from Wednesday as a stop loss, because that's too far away.
Yeah, that's right. It's all about quantifying your term as well. Blake 7, let me know what your long term means, and we'll have a look at that. But it really depends on your duration. And on that note, that's all the time we have for. But Axel, wonderful having you on. Pleasure as always. Hope you have a nice and restful rest of the Valentine's Day.
Probably not, but this evening definitely. Have a nice weekend, everyone. Same to you, Angeline. Bye.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
CFD trading is the buying and selling of CFDs, or contracts for difference. As a derivative product, CFDs enable you to trade shares, indices, forex, commodities and more, without ever needing to own the underlying asset. When you trade CFDs, you trade the difference in the price of an asset from the point at which the contract is opened to when it's closed. As you don't own the underlying asset, you can trade markets that are falling as well as those that are rising. So, how exactly do you trade CFDs? Each contract has a buy and a sell price. Sell prices are slightly lower than the current market price, and buy prices are slightly higher. The difference between the two is referred to as the spread. If you think the market will rise, you would buy. This is called going long. If you think the market will fall, you would sell, known as going short. The more the market moves in the direction you predict, the larger your profits. If it moves in the opposite direction, the greater your loss. CFDs are traded on leverage, which means that you only need a small deposit, known as a margin, to gain full market exposure. So, if you wanted to open a position equivalent to 500 Apple shares, you might only need to put up 20% of the cost. Your profit or loss is calculated based on the full value of the trade, however, which could mean magnified gains, but also magnified losses. So, when trading CFDs, you should always keep an eye on the potential downside. Take care to manage your risk with stops and limits. Visit IG Academy to learn more.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
That is very funny. I was standing in the gallery and watching the comments come through, and somebody's comment that please get that woman the next shiny new thing. Enough already. So we're reviewing yeah, exactly. Some of those adverts. We're working on new adverts, I promise people, so you won't have to listen to the same thing over and over and over.
That jingle seared into my mind. Like
Yeah.
I wake up in the morning, I hear that advert. Oh my God.
Right, so we are back into our beginner's guide to options. Welcome to Market Measures. Today, we're looking at understanding call options are theoretically equivalent to 100 shares of long stock for the call owner and 100 shares of short stock for the call seller, right? So we looked at buying calls and selling calls yesterday. Now, where a lot of people get mixed up is they hear selling and they think put, right? But there are the 4 options. You can buy and sell calls, or you can buy and sell puts. So today we're going through puts. A put contract is the opposite. Instead of buying a call for speculation to the upside, investors typically buy puts for speculation to the downside, or to hedge their long exposure to shares. Put options, similar to call options, represent 100 shares of stock, but allow the holder to sell at a set price for a limited time, making them valuable when stocks drop. When you own a put option, you can sell shares at the higher price than the market if stock prices fall, acting as a form of insurance for stockholders. So think of it exactly like car insurance, home insurance, contents. So yeah, it's insurance for your stock position to lock in a selling price, though it does require paying your premium. Now, if stock prices rise above the put strike price at expiration, remember we looked at strike price yesterday. So if the underlying stock prices rise above the put strike price at expiration, the put option becomes worthless as selling at market. The put option becomes worthless as selling at market prices is preferable.
And also a good way of remembering that fixed price is the strike price, which represents it, is the price at which you can buy or sell the asset.
Yes.
Long puts, buying a put option grants the right to sell 100 shares at the strike price, profiting if the stock price falls below this level by expiration. To be profitable, the stock must drop enough to cover the premium paid, as the value of the put increases when the stock price is below the strike price. Short puts. This means selling a put obligates you to buy 100 shares at the strike price if the stock falls below it by expiration. Profit is then made if the stock price stays the same, rises, or does not fall below the strike, allowing you to keep the premium collected up front and using it to offset potential losses if the stock declines.
Exactly. So long puts is a bearish strategy. Short puts is a bullish strategy. Right, let's look at our examples on the Tasty platform then. Buying a put. So that means that you have to pay premium. So it's a debit. The debit is equal to the initial premium, 128 in this case. The max loss is equal to the debit, right? So it's a fixed loss. And in this one, that is the second or the furthest right yellow circle. Max profit is the amount you receive if the stock goes to zero. Okay, so it looks like a huge max profit there, but that calculation is always a little bit meaningless in that, you know, very, very few options go to, stocks go to zero. Now, what about the opposite, selling a put? So that means, of course, you get a credit. You are selling the put to the market, and therefore you are given a premium. Okay, so I am short the put and I receive premium, I receive money for taking that risk, because you're taking the risk and somebody else has the decision to make. The credit is equal to the max profit, and the max loss occurs if the stock goes to zero. Okay, so it's the same as buying shares. You will own that exposure all the way down. So think of it like buying stock, that, you know, anytime you buy stock, then your max loss is if the stock goes to zero. But nobody ever puts that number right in front of you to scare you.
Yeah.
Yeah, so that is selling a put and how it looks on the platform. Angeline.
So here are the handy graphs for you to snapshot and print out. So this long put profit graph and short put profit graph. It just is a visualization of how this strategy unfolds. On first glance, it may seem like buying puts is much better than selling puts, as the profit is capped for selling puts. Well, the losses are much larger. The stock can go to zero, just remember. However, just like with calls, there are many factors, and we'll try and cover as many as possible for you, that may make certain option strategies better under certain conditions. For example, in a bullish market, which can occur the majority of the time, the probability that a stock will go down to zero is very slim, limiting our profits for long puts.
And just so you get used to those, the pictorial representation there, think of the price as going from the left-hand side is lower, and the price moving to the right is the price going up. So I know it's tough because, of course, normally you expect the price to go up, would be shown by it going up. But no, on this one, the movement to the right is the stock going higher. And that's why you see the stock price and the strike on that line. Right, this is the one to screenshot as well. So get used to this, because this is the cheat sheet of all cheat sheets when it comes to options. What is your strategy? In what market sentiment should you use that strategy? What is the optimal volatility, which of course will come on to explaining what volatility really is in a lesson next week. In what event is it suitable to trade that strategy? And what are the key factors to monitor, right? So there's so much in that slide. That slide is a whole market measures in itself, which we will come back to, and we'll go over this again and again so we can really, like they do when you're learning a different language, we'll make sure that stays in.
What is it they say? 11 times. You need to say or learn it 11 times before it gets put from your short-term to your long-term memory.
That's right.
And it's quite tricky, but stick with it, guys, because I know you can do it. Even for myself, I have to think of like different visualizations. So when we're talking about this, I think of a car. Like a put option is like having the right to sell your car at a set price, even though my car is pretty much going close to worthless now. With all the government tinkering with, diesel regulations. So yeah, just find a way that works for you, and we'll be with you along the journey.
And this, I say this slide stuff. There's a lot there. We're not going to do it justice in a kind of 2-minute summary. So next week we'll go through that in a real deep dive look. But very simple example on this. You hear me talking about being short puts on Vodafone, right? Now that is because you can see on the bottom line there, that is a bullish to neutral strategy. Vodafone keep on messing up in Germany, and those numbers aren't great. I'm bullish on the stock because of the buyback, but I'm also neutral at the same time because of the underlying business is struggling in Germany. So therefore, I want to short the puts rather than buying a long call, because a long call is outright bullish. And yeah, that gives, you do that in stable market expectations. So what is the takeaway, Angeline?
So if you ever take just 2 things from this entire segment, being long a put contract allows you to sell 100 shares of stock at the strike price. Long put contracts are profitable at expiration if the stock price is below the strike price chosen by more than the premium paid for the contract. And being short a put contract obligates you to buy or be put, hence the saying, 100 shares of stock, yes, put it to you, at the strike price that's been chosen if the stock is below that strike at expiration. It allows you to bet against the movement of the stock, but exposes you to undefined risks to the downside. Short put contracts are 100% profitable if the stock price is above the strike price at expiration.
Wonderful. So that is your understanding put options beginner's guide. Great question there from R6Sena. Can we provide the background of the PowerPoint to be white?
Reality of the recent speech by him.
The speeches, in particular. Yeah.
I've been seeing a lot more of the, the what we call the one hand statement. On the one hand, on the other, and he said something like, higher inflation is a possible outcome which will depend. On specific facts. And then he went on to then say,
which, by the way, is true of every moment in all of history.
Exactly, right? And then the funny thing is, it didn't stop there. It went to, in some cases, it does not reach the consumer much. In some cases, it does. Right?
And I think it's one of those weird things where the Fed has kind of got themselves into a bit of a sticky situation because of the way that they used forward guidance as a policy instrument. So because they were using the words they used and the precision of those words to influence the longer end of the yield curve, the market got really, really used to looking word by word what the statement was saying.
How many times it was said.
Exactly, and how they respond in the presser to Q&A. And I think the aim now, from what I'm understanding of Jay Powell and the Fed, is to move a little bit away from that over-specified guidance and a bit more towards what he calls data dependency, but what I think we would call more traditional central banking, where it's a bit more where the policy instruments and the levers you pull are monetary in their nature. They're not verbal in their nature. And so I think that adjustment is going to be slightly weird for the market to absorb, but it also means, like, often events that might seem really boring might actually be a bit more of a catalyst than normal. And I think minutes is a good example where there's to me, an 85% chance it's totally a non-event. And there's like a 15% chance that there's something really interesting in there. And I think it's one of those things where you're probably right. In most cases, it's extremely boring. I'm definitely going to have a read this time and see how it compares to the statement and the presser.
And Richie Rich will be having his microwave meal and a glass of wine.
Hey, that sounds like a great evening. Print out the Fed minute.
Is he doing that because his girlfriend, he said, Rahel, is off skiing today? So is that his Valentine's tonight? Pulling up the, just before we go, the CME Fed Watch tool. If you want to whack that up for our trader friends there. What's interesting is, how much, the whole mood music has changed, even in the last week, right? Where now I'm seeing like some...
So if you actually hit the compare button, which is just on the, exactly, you can see how that's changed over time.
Yeah, it's unbelievable.
And if you go out a little bit further, if you go out
September?
To maybe, September, October, either
September's
way.
the key time, right?
Look at that, right? I think markets have just been edging closer and closer and closer to this understanding that almost nothing's going to change. Which is fascinating. If you go out even further,
and then we'll go to April next year.
You can see that like kind of constant up and down cycle. So you can't compare by the time you get out too far. But if you look, you can see really markets are responding a lot, both up and down, in terms of what the macro data is saying around their expectation of rates. And I think that is the side effect of data dependency, is that you then borrow the volatility that comes from the data releases in your yield curve. And so where you see this kind of up and down cycle, look at the 425 to 450 bips rate right on the far end. Look at that light blue line versus the dark blue line. You've had like a lot of volatility in that end of the yield curve. And so I think that to me is a symptom of the data dependency. And like as a trader, like you can build off that volatility and take that to be a useful way of kind of either selling vol or thinking about how you can take small advantages on short-term movements.
I love this function, and actually I've been looking for a UK version of the compare function. Have you ever seen one?
I haven't seen one.
I've had to like Excel spreadsheet. Trader friends, if you know of a compare chart like this, but for UK interest rates, please let me know, because one of my mortgages is coming to the
up for renewal,
of its fixed, and I think I've done pretty well on that, like 3-year fixed, but it's coming to the end now. So rather than having to face my Excel spreadsheet and a very basic Casio calculator, very simple.
You'd rather have a nice fancy tool.
Yeah. I'll build me one. We've got quite a lot of engineers on the show.
Great. I think, so one small bit of data that I always try and use is the Bank of England, when they do their quarterly inflation reports, have market implied probabilities of where rates will be. And that's always a really useful data set. It's very hard to see how that changes over time because the Bank of England doesn't publish super regular data on it. But I think comparing one quarter to the previous one, you can see quite material moves.
I use the FTE003 function on the LSEG Reuters.
Oh, cool.
It does require a calculator.
Yeah.
But I'll come and take you up on that offer.
Yeah, I'll show you.
Let's whack up the corporates because it is also very, very
also big week for earnings.
HSBC, the key one there, and it comes in a time when there are loads of redundancies there in the UK.
Yeah, and I think if we just take a step back, we've had a couple of weeks with big tech earnings. I think next week is a very quiet week in terms of tech earnings, and so we're focusing on some of the other industries that we think are going to be bigger movers next week. So that's the UK banks, some of the energy and industrial goods companies across both the US and the UK. So we've got Oxy here and we've got Rio Tinto. And then obviously Walmart is going to be quite a big one in terms of moving from a US retail perspective. So if we think about the banks, you're right, there have definitely been lots of talk about layoffs. And actually there have been significant parts of different businesses that have been shut down. So HSBC made an announcement a couple of months ago about their asset management side of the business and a general shake-up of how the business is going to work. I think the focus of HSBC is to really focus on the core markets and spend less time on their much smaller markets. And that kind of focus is really interesting, especially compared to actually another bank who isn't on this slide, but is also doing earnings next week, which is Standard Chartered, who might try and fill some of that gap actually, where HSBC might be leaving a market.
And it comes after better than expected results from NatWest. I mean, we were saying solid, right? Despite
really solid, yeah.
Some of the, what its shares were doing earlier today, we're saying that's probably more like profit taking because its numbers were so solid, down 2.7% at the moment. But we also have Lloyd's in the coming week. Lloyd's is one that is also very interesting because it is well held. There you go. Whoa. I got my chart up for you guys. Lloyd's here. Because I'm going to put up.
Lloyd's has been going through this big transformation journey.
It has got decent dividend yield of 4.5% as well. You know, decent market cap, 39 billion there. But the transformation, as you say, it looks like it's turning a corner, doesn't it?
Yeah, I mean, it's very hard sometimes to separate the FX effects of some of these charts versus the underlying. But Lloyd's actually is a company that looks like they've been putting in the work to try and transform how they run as a business. And so it's definitely one of those stories where, as an outside-in investor, it might be one which is looking much more appealing than it did a couple of years ago, for example.
Lloyd's,
it's part of your buy and hold portfolio?
And HSBC is part of my buy and hold. So good thing you asked actually, because I will show you. So you were here.
Yeah.
And actually you talked me into diversifying away from my tech and my Nvidia.
I said it would be, I said it might be sensible to have some other exposure.
You saw me the next day biting on the stick going, I've done it. HSBC, as we mentioned earlier, is within this, but so is the Shells, the BP. That thank you, Elliot. Elliot, and AstraZeneca, GSK, because of the it's good to have pharmaceuticals. Bad times, good times, terrible times. You still need drugs.
And you're not saying you're moving totally away from tech. It's just slightly increasing your exposure to some of these companies.
Exactly, and taking some off Nvidia. And then we got Relax, which has done very well.
Yeah, that's the stock exchange.
And also software.
Yeah, exactly.
Rio Tinto, which is also dividend play. National Grid, which has done quite well given uncertainties every time, which rocks the market. So it's held itself really well.
So I think these are all kind of like low beta.
Exactly,
plays, right?
low volatility. One that you can sleep at night.
Yeah.
And Eli Lilly is just because I think I've already got Novo Nordisk, so Eli Lilly is just in addition to the whole if obesity doesn't get you, diabetes probably will.
Yeah, and I think some of these GLP-1 drugs like really do have potential. You saw quite weak earnings from McDonald's, especially in the US, and like it doesn't seem like that's immediately an effect of some of these drugs, but like actually if you're looking at relatively, would I rather own GLP-1 based pharmaceutical companies or a fast food company? I don't know. I'm much more torn than I used to be. I think I used to be quite bullish McDonald's, but yeah, definitely not the strongest of earnings. You can see that they're actually back. So they had their earnings, they took a big downward correction, but then they kind of back to normal. I think on if you look at the daily, for example. Yeah, there you go.
Yeah, and it's creeping back towards that level. But if we zoom out slightly, it is range bound, isn't it? I mean, really.
At the moment, yeah.
And if we go monthly chart, it is higher. But if you look at the last, since 2002 onwards, it is pretty range bound.
It's a quality company though, and
it is a quality company.
I think if I'm thinking about my buy and hold portfolio, it's always nice to own quality companies.
And a lot of people don't, and they forget that actually this is not just about its franchise, it's also about real estate.
Yes.
Let's be clear.
Yeah, but it's also about things like what their input costs are, and at the moment the cost of eggs is very high, and so like their breakfast menu is probably making a lot less money than it used to. And so yeah, I think a company like McDonald's is a really kind of interesting, complex one. But we've got plenty more earnings to talk about this week.
Okay, let's whack up the chart.
Should we think about energy and industrial goods?
Yeah.
Do you mind pulling up Oxy?
Let's pull up Oxy.
So for those who don't know, Occidental Petroleum, or Oxy, which is the ticker it has, is one of Warren Buffett's biggest holdings. It has a huge interest in shale drilling and fracking in the US, especially in the Permian Basin, and is a high cash generation business, especially at a time where energy prices have been kind of somewhat volatile and in some cases quite elevated. So you can see Oxy has earnings coming up next week. I think energy in general is going to be a really interesting sector because you've got kind of a combination of the like drill baby drill dynamics that Trump has been talking about, but also some of the tariff dynamics, and also fundamentally some of the AI stuff, where like if you really believe AI is going to be this kind of transformational play, then it's going to require a lot of energy, and it's not super clear how much of that can be done through kind of traditional energy means. And so looking at things like oil and gas producers is a really useful indicator of kind of where they expect that demand to be.
And it's interesting that you bring up AI because, if you speak to anyone in the exploration space, whether it is, petroleum or whether it's mining, they can say you can sink as much money as you want into satellite images, into cores, drilling cores, but essentially you don't know until you blow.
Until you drill.
Yeah, until you blow a hole in the ground,
Yeah.
or you drill, and by that time, the expense is huge.
Yeah.
And
actually they run like extremely well operated organizations, right? A company like Oxy will know exactly what the break-even price is for most of its fracking work. And if the oil price dips just a little bit below that break-even price, they won't do any action. And if it goes right above that break-even price, they'll drill. And so I think having that cost control and discipline, it's not just Oxy, there are a whole bunch of really well-run organizations that do this really well, but it's a business that is very sensitive to what commodity prices are doing, but it's also a business that's very efficient, capital intensive, and kind of quite thoughtfully run typically.
there's a joke in Perth, Australia, that when the copper price goes below a certain point, it's like suddenly
it's like a ghost town.
It's like a ghost town, or loads of people playing golf.
You could tell what the oil price was by looking at the cars on the road versus the cars in the secondhand shops. And basically, when oil prices are high, everyone is driving fancy cars on the road. And when oil prices are low, if you want a secondhand, really nice car, you can get one at an absolute sweetheart deal. So it's definitely one of those like places where it's very sensitive to commodity prices.
Yeah. And here's the other thing too. We've got 2 minutes to show you the oil price right now, because we have seen oil majors talk about this price, which many oil producing countries have said is too low.
Yeah.
Right? And we've got Trump on the other hand saying he wants it all to come down at the pump.
He's just said he thinks the way of reducing inflation is to drill for more oil. But he has also said at the same time he wants to refill the strategic petroleum reserve. And so we'll probably at some point start to see a bottom in the price of oil as he'll kind of provide a bit more sustained demand.
You know, we've got, in addition to these levels, we've got Chevron saying it's going to cut 20% of its global workforce. We have
Rio Tinto earnings next week, which is not energy, but it is industrial goods and commodities.
Yeah, let's have a look at Rio because I have that in the Ong pension fund. Rio Tinto, finally, making some inroads on the upside. It's climbing higher.
It's been a good run in the start of February, I think, right?
Yeah, and it's broken past, you know, the high seen mid-January. And I'm hoping that means it's going to punch through and break through and head towards levels last seen in October. But Rio Tinto is an interesting one because it's going to be tariff related too.
Yeah, agree. And I think especially when it comes to things like additional tariffs specifically on China, it will really impact supply. So with the last minute, it would be great if you could pull up Walmart.
Okay, let's try and get Walmart up.
The final earnings that I'm really going to pay attention to next week. Also because I think it's just always an interesting organization to look at. It's had an amazing run. Look at that chart. Isn't that crazy?
That is crazy. This is the monthly chart, trader friends.
That's mad.
Now, if I had to choose one of the retailers there in this
Walmart or Target,
it would be Walmart.
You think it would be Walmart?
Because I think I've told you this before. It is insidious.
Oh yeah, it's everywhere.
It's everywhere. And like, if it's not doing well, what you'll find with a Walmart is it'll put, and it knows a competitor's doing well, it'll put a big kick-ass, huge one, even though it's like making a loss.
It's like a statement.
Yeah, it's a statement. And there's so many Walmarts in the US that when you're traveling around and, you know, looking at the, how is this even viable from a business? Like, there's no one.
They're doing a lot better than Target is.
Yeah, and it's 24 hours, some of them, 24 hours. You can say that they only serve the truckers. Some people say, well, you know, it's there to serve the deliveries. I'm telling you that there's not enough footfall, and it's basically just there to kill off competition.
Interesting. It's definitely one that I'm looking at the earnings just to see where they land.
Yeah.
It also tells you a lot about the strength of the consumer.
For those of you trading Walmart and you're looking at the earnings, pay attention to two things, right? This weekend, pay attention to two things from Walmart. One, the biggest growth margin is from baby care.
Interesting.
So if the margin's really good there and it says continued growth, it's like unbelievable. You go in and you can buy everything from like baby kit to baby beds to baby.
Wait, so is baby care, and what was the second thing to look for?
It's consumer products. So your skin care, your hair care, your your bath towels, that segment.
I think we're being counted down, so we've given everyone an extra 90 seconds of
We
content.
have, yes. They're about to have a strike in there. All right. Have a great weekend and happy Valentine's, everyone.
Stocks ignore the tariff news. Are tariffs even coming? It's Thursday, February 13th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan. And what's been my best trading day of the year. This Thursday, we see a market that is moving up because the tariffs are, I guess they're coming, Ilya. Maybe sometime in April, perhaps. The Calvin Ball tariff dance continues where they change form and shape depending upon what the immediate needs of the administration are. And the market, seeing through it, is beginning to shake it all off. S&P up by just about 1% here, 0.98% on the day, 6132. The NASDAQ up by 1.3%, 22,087. Dow up by 0.77%, and the Russell up by 1.07. Bond yields reverse hard. Rate cut odds reverse hard, notably, which were back down to December, have now returned to July. A meaningful swing after the PPI news this morning, showing that price pressures aren't being pushed along. Gold, new closing high. Silver pushes up towards its yearly high. Copper's back on the up and up. The dollar's still struggling a bit here, though. In any event, we're going to talk through all this over the next hour. If you're joining us on the platform or on the website, come over to YouTube. Tell us what you're trading today, what you think of this market action. If you're already on YouTube, come over to the platform, trade with us, see what we're all about. Go to tastylive.com for more information. Dylan, we do have a full hour here today. It feels like the chips are settling. We closed the gap with DeepSeek. It's the highest close in the NASDAQ since December 17th. The markets absorbed these body blows in recent days, and it now feels like we are laughing off the tariff threat. We've come to see it as a negotiating tool, and we really need not consider ourselves to be too worried about it. Are we on the precipice of the next major leg up?
Yeah, I mean, my old interpret. How do I say this? My sense is that the market's been sideways, waiting to see whether Trump is really going to do any of the crazy things he says. The longer this goes on, and the more it appears, the more that the doublespeak continues to validate the idea that Trump's not going to do most, if not all, of the crazy things that he says. Most importantly, the tariffs, but secondarily, Canada, Greenland, all this jazz.
Red, white, and blue land, actually.
Whatever it may be. It creates the opportunity for the market to go higher. Right? And how do I say this? The less credible Trump becomes with his most outlandish comments, the better it is for the stock market, particularly when it comes to things revolving around economic policy, and specifically as it relates to the never-ending tariff threats that don't seem to ever happen.
Oh yeah, the market takes
surprise no one that I have a less optimistic view of what's going on here.
Well, I would say yours is the exact opposite. Yours is like the market is going sideways, waiting to go down when all hell breaks loose. Not because of Trump's going to do something, but because there's an economic slowdown brewing.
But before you get into that, though, could you explain what reciprocal tariffs are and why this is a point of focus right now? What it means ultimately if we apply them as opposed to like a 25% across the board on aluminum and steel?
Sure.
What's the context here?
So basically what this means is that the U.S. is going to go through all of the trading partners and see if there is a misalignment in tariff rates. That is to say, if we charge them or importers of goods from them, because let's be clear, countries don't charge each other tariffs. That's not how that works. One country does not have the sovereign override over another to go, you owe me taxes. What happens is a country taxes importers of goods from certain foreign countries, or all of them, whatever. But you're ultimately taxing importers that you have legislative authority over within your own borders. So the reciprocal tariffs would be a study, as we've learned, where we go through and say, if a given country has tariffs facing our goods that are higher than our tariffs facing their goods, we are going to adjust ours higher to close the gap. And this can be a treacherous effort because you have to go goods by good, category by category, trading partner by trading partner, and then whether the tariffs are actually higher or what sort of mix of tariffs, quotas, other non-trade barriers exist. If you want to factor in the full story, you can be at this for a long time attempting to figure out where sort of neutral and balanced is. But the general idea was that we'd go through, find all the areas where countries levied tariffs on us that were higher than tariffs we levied on them and their goods, and close the gap by raising U.S. tariffs. Today, we learn from the Commerce Secretary and the President that indeed they are coming, apparently, but that all of this complicated figuring out of what goes where and who owes what to who is going to be a process that we're going to go one by one with the trading partners, and that maybe we'll get everything figured out by April or so. Now, of course, everything that we've just seen from Canada and Mexico, the tariffs that came and went in less than 24 hours, this opens a really big window for negotiation. And for example, allies like the European Union countries have already started lobbying for, hey, you don't need to do tariffs. Here's a deal. Here's how it's going to work, et cetera, et cetera. In other words, this is an invitation to discuss, not the kind of thing, for example, that happened with China where tariffs just appeared. And indeed, there was an extra 10% added there, but nobody didn't expect that. The hawkishness with China is something that's bipartisan and generally now a conversation being had in virtually every Western economy everywhere. So that part was consensus. What this did clearly was say, we're going to take the risk of a whole bunch of tariffs on allies ostensibly to close imbalances appearing now, to maybe this doesn't happen at all because the window to talk these away now is big and long lasting.
Dylan, it feels like we have somewhat of a validation of the view that the tariffs are negotiating tools. And certainly, similar to the efforts, I mean, Trump says it today, you know, he might push for an extension on his delay sale of TikTok, the executive order that happened immediately when he came into office. And I think our interpretation has been that's a fig leaf to the Chinese government, that like if he really wanted to ratchet up the trade war, he would have pulled all those levers. TikTok would have been banned, forced sale, 25% across the bow tariff, right? And instead, there's these windows for implementation and review, which quite frankly, it sounds like the conversation is going to go something like, hey, EU, it looks like you have a tariff of 15% on this good. We're charging you 0% on our tariff. Does that sound right to you? And the EU will say, no, actually, we have a 0% tariff on you guys now. Is that what your data says? And the Trump team will go, yep, that's what it looks like. Or the EU will say, no, you're correct. We have a 15% tariff on you. And the US will say, oh, you know what? Actually, my data is wrong. We have a 15% tariff on you too now. It's going to be over every little item back and forth. So again, is it going to be a full reciprocal tariff where we match every single rate? I mean, this could be something that then brings down trade barriers. And if it does, then it's a negotiating tool. And if it's a negotiating tool, then the markets perhaps see these risks and need not be concerned, which raises the question, is tomorrow, Ilya, going to be a replay of next week or last week or the week before? Because the last few weeks going into Friday, we've had a market that rallied like Monday, Tuesday, Wednesday. Thursday, we peaked out. Friday, we sold off. Monday, gap open lower. We just got the reciprocal tariff talk today. I mean, should we be expecting some sort of tariff catalyst over the next few days that may cause de-risking tomorrow afternoon?
Well, that's just the thing. You don't know. And I think what the markets are operating on at this point is the expectation that weekend risk as a structural thing has become elevated because the new administration is such that they make announcements over weekends. They don't take a whole lot of time to workshop these things. Instead, they sort of like to do it live. So you might get a piece of news, and then in 24 to 48 hours, it's reversed. And then there's more details, and then there's not. And so when markets can operate when things are open, they can sort of pivot around these things in real time. When markets are closed and the news still comes out, there's obviously gap risk in case something is announced. Maybe it's tariffs. Maybe it's the first volley in this negotiation around the Russia-Ukraine war that apparently is kicking off in earnest now that the president has spoken with Vladimir Putin, as we hear today. Maybe it's some sort of movement in the Middle Eastern theater after the visit from King Abdullah of Jordan, and this idea that Egypt is trying to push a plan whereby the entire population of Gaza isn't displaced from their territory. So it's, who knows where it comes from, but the idea that there is just generally greater weekend gap risk and that's what's normal now, that seems to not necessarily have to do with one thing or another. That just seems to be a function of the environment now. But the issue tomorrow is actually larger than that before we get even to any of this, and it's the retail sales report. Because in my mind, all of these back and forth gyrations on the tariffs are ultimately noise. The larger issue is that there is a business cycle situation that's starting to take shape in an untoward fashion. We learned from the CPI report yesterday, as we discussed, that the hotness at the headline was not the kind of thing that has to do with the core of the economy. The service sector, the only thing in the world really that's still growing, the U.S. service sector, it actually cooled, which confirmed the purchasing manager index numbers we got last week that gave us the weakest service sector in a year, if you ask S&P Global, and in about half year, if you ask ISM. There is every concern then that if you get a soft retail sales number, in particular after that very disconcerting University of Michigan consumer confidence report last week, which the markets didn't like at all. In fact, they shrugged off NFP and sold off on that.
Yeah.
When you consider what that retail sales report says, if it says that retail sales, which already are expected to decline, fell more than expected, forget the tariffs. That's just smoke and mirrors. The larger issue is what the economy is already doing. If the tariffs then appear, then that makes things worse. If they don't appear, it doesn't make things any better. That's the larger issue here. And if you look at the S&P, you look at NASDAQ, yeah, they're up today on this reprieve from the tariff gods, but NASDAQ hasn't made a new high since before the start of the year. It's at the top of a long range. The risk reward here, as a matter of fact, to be newly long, if you haven't been long already, has only become worse by the absence of a breakout.
Is it an absence of a breakout, though?
Huh?
Is it an absence of a breakout? I mean, this is the highest close we've had since December 17th. We're above,
and yet we still can't get over the top of the range. We've seen this kind of breakout before. It faltered somewhere in the middle of last month.
Listen, Becky, we can't catch a break with this guy. I got to tell you right now. I guess I don't know what to tell you. You're going to try and try. You know, but I think that
show me a market breakout. That's all I'm asking.
I understand, but I also think that you make an interesting point, which is that if you ignore a lot of the jibber jabber, that the economic data is indicating rising inflation and a slowing economy.
Yeah.
On the marginal indication is weakening of economic data ish, and more for sure, clearly increasing inflation pressure.
And the inflation pressure is increasing for the wrong reasons.
For the wrong reason. Not to mention, a friend of mine told me that the second half of February tends to be weak.
Isn't there is that. Which,
Yes, there is.
we are, I'm a seasonal guy, right? And we have to be intellectually honest with ourselves. The seasonal drumbeat is that the market tends to decline in the second half of the month. Likewise, the market typically trades sideways from the start of the year into the middle of March till about March 15th, and then the resolution to the upside occurs. Again, not surprising. The past 20 years, markets have mostly marched higher. So, yeah, I mean, if you're looking for a reason, it's not tomorrow, although the 15th is on Saturday, so the market's technically closed. Tomorrow would be the seasonal peak. This comes from Ryan Detrick over, Coinbase. I'm not sure if Tom's going to be happy. Coinbase revenue surges.
Well, you can't just say that and not tell us.
I'm going to read it now. Coinbase surges more than 130% revenue. Okay. EPS 468 versus 181 expected. It's a fair amount of money. Not bad. Not too shabby. Coinbase shares themselves here, though. That's the different story. Despite it being very good news and information, they're only up about 2% here after hours. We'll see what their forward guidance says, because obviously if they continue with 130% year-over-year revenue growth, the company's probably undervalued at $300 a share. But that's going to be coming up shortly, I think in about an hour time. So keep an eye on that. But Coinbase here, very, very impressive earnings. EPS, again, 468 versus 181 expected. Wow. That's a big number.
Kind of makes sense given how much centrality there was around crypto in the presidential campaign and everything that's followed.
And Bitcoin, almost doubling.
Lots of speculative interest. Yeah, I mean, lots and lots of speculative interest in crypto. And if you are the facilitator of said speculative interest, you've probably done well.
Yes. Let's go back to the conversation about seasonality, though, in the broader markets.
Yes.
So if tomorrow, right, retail sales comes in and all of a sudden the market turns to the downside and today's gains are erased and you're back below 6,100 in ES and, the NASDAQ's trading below 21, we'll call it 750 or so. You can peer through that window and say with a higher degree of confidence that this range is going to continue to hold for the foreseeable future. But the flip side of it is if tomorrow we continue to press higher here in ES, right, we're all of a sudden talking about a high close for the year. That could be, the high close of the year right now is 61.52. 17 points is nothing. We did that and then some from when the tariff announcement came out.
Yep.
In fact, on Futures Power Hour, we were questioning, where do we see this 10-point ES drop from 61 down to 60.90? So the market is, 40-odd points higher from about 1:30 p.m. Eastern time today. And another 17 points to a new fresh closing high for the year in ES is, if retail sales aren't the end of the world tomorrow, which they are expected to be negative 0.1% month over month anticipated. Stocks right now are starting to look like they want to squeeze to the upside a little bit. And that was kind of the name of the game today. Nick was passing along various tickers, like a bunch of these, junky names. I don't want to call them junk because that's not fair and denigrates the shareholders. But a lot of these names that have been kind of the high flying, they were flying high over the course of today's session. Perhaps one way to think about this is even ARK, ARKK. That was up 3.32%. So there's maybe some speculative froth setting in here right now. I suppose the question is, what do we do next? Ilya, it sounds like you're going to be retaining your bearish exposure for the time being.
I'm not going to do anything here between probably the end of the week. I mean, it'll depend, of course, what retail sales does. If there's a clear breakout, then I need to be as mindful of weekend risk as anyone else. And so I'll be looking at it. And I'm also coming up on expiration on some of my exposure. So I need to think about whether I want to roll it or not.
Sorry, when you say expiration, do you mean 0 DTE or 21?
Oh, no. So I'm approaching 0, and this is already the second sort of roll in these shorts. So markets topped in December. I was short them then. And so I had a nice run into the beginning of the year as everything came off, took that off, and then got back in essentially. And so this second layer of it has been sitting around for, just about a month at this point. And so now that it's sort of coming up on maybe about 9 days to expiration, something basically has to happen next week, and then I need to either roll it or not. And of course, next week is abridged because Monday is a holiday. So it's a lot of weekend risk. It's a 3-day weekend with the President's Day holiday, probably the kind of time that pronouncements from DC might come. There's an occasion for it, as it were. And so I may decide, depending on what happens tomorrow, you know what, these particular verticals are at max loss. They were capped for a reason, because shorting the stock market is generally a bad idea. And so it's a market that's biased higher and doesn't want to go down, as we begrudgingly see here. It's been going absolutely nowhere since early January. Even though it's had reasons to come down, it's held up. So either I let these things expire and give me the small loss that I bargained for when I bought these verticals, or I roll them. And so it's going to have to make some real momentous move on the downside for me to go, okay, I'm ready to just say, you know what, let's extend duration here. I don't want to even think about this next week. But chances are I let it go, and worst case, roll it mid next week with almost no time left.
Dylan, do you think I should retain bullish exposure?
Absolutely. I mean, I'm not as nakedly bullish as you are, but I mean, I still have that Tesla position, which I consider to be wildly bullish from a few days ago. I mean, but that's stock specific. I don't have an index position, but I've got something going, and I can't imagine how. I just feel like all the vibes are in favor of a rally, and I think the longer this goes on, that Trump is more bark than bite. It only gets better.
What's the vibe situation that you're feeling? That you're alluding to?
I mean, it is that the market's absence of rallying is because under the Biden administration, as I said a few days ago, we knew it was a predictable administration, and so we could put them in a place. Mm-hmm. This is a new administration run by a notably chaotic, a man known for notably chaotic rhetoric, if not necessarily action. And I believe the market has gone into a pause mode, logically, for a period of a few weeks, simply to get a handle on how much of this is, again, purely rhetorical, and how much of this is going to be action. And I believe that history shows us that Trump is generally largely performative and less action. And that ultimately this kind of goes back to your rhetoric from pre-election, where this is going to be a standard Republican administration, less regulation, lower taxes, and that those types of things are going to be market positive. Now, you know, I don't worry so much about the economic data. I know that's why I'm interested to sort of interrogate Ilya a little bit more about what he sees in it. But I am a little bit concerned about the inflation data, even though the market is not. And so for me, the only sort of caveat or the only hesitation that I have at all from my being more nakedly bullish is an inflation concern more than it is an economic weakness concern. And the reason that I'm optimistic is because I believe Donald Trump is ultimately a performative individual more than he is someone who's actually going to implement a bunch of policies that are any more deviant than what would be a normal Republican majority administration, which people may not like on the social side. They may get anxious about it and this and that. But when it comes down to the actual performance of companies and the sales of goods and services in the private sector, domestically and internationally, that it will tend to benefit from lower regulation and lower taxes, even if that benefit tends to accrue to an increasingly smaller percentage of the American population, which obviously it does by virtue of all the wealth consolidation and wealth extremes that have developed not only in the U.S., but around the world. That's a massive political and social issue that ultimately at some point I think is going to yield incredibly bad consequences. But between here and there, and that I don't know where there is, I do believe that ultimately it's better for the value of publicly traded stocks. And the only thing that stands between where we are today and higher stock prices is some idiotic tax or regulatory decision or tariff decision from the United States government, which the longer this goes on appears to be less and less likely. So thus, I support your long position. But I listen to Ilya very closely, and obviously, who knows from right and wrong, and that's why I'm sort of interested into what Ilya sees that he feels is indicative of a meaningful economic slowdown. Let's pull Trump aside. Let's assume we just have a Republican majority government, a Senate, House, and forget who they are, and that it's a Republican platform, a Republican agenda, less regulation, and lower taxes, and that's really where we are, and then everything else is a performance. And how is that ultimately not? In the intermediate term, long term, it may be bad. Short term, it may be, hard to get a read on. But in the intermediate term, which is how I look at the stock market for the rest of the year, I think it's a good thing. And I think I'm happy to have bought that Tesla position. And I entertain doing more.
I don't. Is it a regular Republican administration? Obviously not, right? They're clearly doing more to dismantle the federal bureaucrocy than anything Bush ever did, right? Or even
by the way,
through executive orders that may not even hold up. I mean, aren't those executive orders ultimately still a performance?
To a certain extent, but when like the vice president's touting Andrew Jackson saying, the chief justice has rendered his decision, let him come enforce it. It's kind of like, okay, you and what army are going to tell us that we can't do this? Just something to watch in the margin. But the big picture, though,
it's certainly the case that employees of the federal government are being removed from their roles, and that's ultimately like any kind of layoff. It is at the end of the day less consumption from those people because they have less income and less economic growth. It's ultimately disinflationary.
Temporarily, because if those people with federal government working credentials want to find jobs in the private sector, there's a fairly good chance they're going to get paid more than they would from working in the government. So
if they can find it.
Maybe. But like in terms of, Dylan, we think about the risks here. Are the tariffs going to be 25% across the board? Is he going to deport 3 million people? I've been watching the deportation rates here again. And last night I was trying to talk with Victor about this. I think we were talking past each other a little bit. What I think personally doesn't matter. We're talking about what to do with our money to position it in the market, right? So facts, the House Appropriations Bill is calling for $4.5 trillion of new debt over the next decade. Doge can make these cuts to flood the zone for the media. Deficit spending is not going anywhere meaningfully, okay? The Federal Reserve's next move that's being priced in by the market is still a cut. Those are two huge macro tentpoles for me. And then if we think about the labor market, concerns with the deportations ultimately lead to destabilization in the agriculture sector or services. We've been deporting on any given day somewhere between 600 and about 1,100 people. The first month of the Trump administration will have about 25,000 people deported. So it seems like shock and awe right now, but 25,000 people a month is going to get us to about 300,000 people this year deported under Trump's first year. Under Biden's last year in office in 2024, 271,000 people were deported. So if we're going from 271 to 300K, if that's really the pace, unless they dramatically step it up, which is of course possible, but given the current run rate, is this an administration that's going to be doing something in the short term that's leading to significant destabilization of the labor market? Not as things have unfolded in reality so far. The rhetoric has been way more aggressive than what one actually assume looking at the data. And And so then if we think about a big shock to GDP and tariffs that are, maybe coming, I feel like the boy who cried wolf at this point with the tariff story. The short-term path or equities looks like we can shake everything off. There's a lot of noise, but the actual numbers, when you put pen to paper, where's the federal deficit going? Where's Fed policy going? What's the state of the labor market? And we're still good enough.
And again, this is all true if what you're looking at as the pivot for the market's sentiment, a sense of whether fiscal policy will be destructive or not destructive for risk appetite. And that's a fine lens, and indeed the markets are sort of anchored here and they're not really going anywhere. You'll notice that the front end yield, the 2-year ZT, that's not going anywhere either. And in about the same period of time, because the markets are trying to reconcile whether any of this fire and fury means anything for near-term interest rates. And the answer increasingly is probably no. But that's one perspective.
Yeah,
nevertheless, through all of this stability, the long end of the curve is telling you something very different.
What is it telling us? Because I couldn't help but notice the evolution of these Fed cut odds the past few days have been really fascinating.
Yes.
Last Friday, going into UMISH sentiment data, what do we say? June is priced in for the first cut.
Yeah.
We come on the other side of CPI. The cut's been pushed back to December. The dust settles now on this PPI Thursday, and we're back to July being favored for the first cut. 62.5%. Again, like 50. If any time the market's been priced in for at least 55%, one way or the other, on the day of the Fed meeting, the Fed has done so in that direction 100% of the time, going back to 1996.
Yes.
So if today was the day of the meeting, we would say, okay, it's if today was July 30th, we would say it's happening.
And the next meeting is not until March.
Sure. So my question is, but why such dramatic ebb and flow? We're not moving like to the next month. We're swinging 6 months.
Right.
Very rapidly back and forth. Why is the market doing that today?
I've thought that the aggregates have been a lot more telling than trying to look at when the next cut is coming. Because the Fed itself has now spent all of this time this week with Powell's testimony, all of the speaking around the last Fed policy announcement, before, during, the December policy announcement where they revised their expectations with the updated SCP that was much less dovish. All of this conversation has been about, we at the Fed are not looking to do anything quickly. So it's not surprising, really, that near-term expectations have jumped around a little bit because the markets don't really know to the granular date where things are going because the Fed is telling them that they don't know. And so when you look at the aggregates, it's actually much more telling. So what I've been looking at is how many rate cuts are expected for this year, how many are expected for next year, and how does the total path of easing shift around. And what you find is things have been remarkably stable. The markets had about 50 basis points through end of next year before CPI. They landed at about 50 basis points through the end of next year afterwards. The real difference was that the makeup this year versus next year shifted. And what we saw today after PPI is essentially it unshifted. So yesterday, the markets thought, okay, fewer cuts in 2025, but they migrate to 2026, so the aggregates remain the same. Today, we unclench because the PPI numbers come in, and they are higher than expected, let's be clear. But when you consider the revisions to December's data, The month-to-month situation looks a little bit better. So headline PPI, higher than expected, but after December's revision, unchanged from the prior month. So it didn't get worse. Core PPI, higher than expected, but a little bit lower after you factor in the previous month's revision. So again, no step in the wrong direction, as it were, in January. And the markets apparently find, okay, fine, let's go back to where we were before. Most of the components, by the way, of PPI that factor into the PCE numbers were not where the inflation was. And so the PCE still looks relatively okay. And were you to have thought that this is good news because what you care about is the near-term Fed policy outlook, stocks probably be a lot higher today. But
that is a very important point. That's a very important point you just raised about the inflation pass-through. I think this is worth, given what we saw out of today's PPI report, and given how the Cleveland Fed's been modeling this out. Granted, the Cleveland Fed was soft on the CPI reading, but they incorporated the new CPI data to update their model to give us a February output. It is updated daily. It shows that inflation would fall off on the month-over-month again, and the year-over-year spike to 3% is immediately going to come back into 2.81. The spike that we saw in PCE and core, core PCE here is remarkably stable throughout all this.
Right.
Okay. It's the headline readings that are being jerked around because of some of these interesting inputs. And so you, on the other side of the two data releases, you look at the things that really do matter and you go, yeah, super core is up, but is it up for like a reason that doesn't really pass through to any other category?
Which is why yesterday's CPI numbers I thought were much more concerning from a growth perspective than the headline numbers were suggesting. Because what was occurring at the headline numbers was mostly, again, smoke and mirrors. And by today, when the PPI numbers came out and they had the same thing, the markets looked at it and said, oh, right, okay, this is fine. And essentially undid what they did yesterday. Because when you look at the core of what's going on, and by the way, uncharacteristically, yesterday, currencies and stocks figured it out. They initially didn't like CPI and then came back to basically unched on the day. It was bonds that had the big move, and then today completely erased it. Because the whole idea was, wait, that wasn't real headline inflation that we saw yesterday. Because the underlying core services sector, the only place where there is any inflation of substance, it actually had the lowest contribution to overall price growth since early 2022. It cooled, and significantly. And that's the economy. That's growth.
Well, 2 points here. Well, 3, I suppose. 1, for the people in the company working, you know that I actually do my job here because my cookies ads are showing up with Tasty Trade ads. Secondly, in the FinViz heat map here today, we see a big sea of green. Every single sector ETF that we follow is green today, led by telecom up by 2.25%, materials up by 1.74%, XME, the metals and mining up by 1.61%. That's not really a surprise given what we've seen in the metal space over the past few days. The worst performing sectors were utilities, industrials, healthcare, which more defensive type of names. So I suppose that's broadly speaking good. We talk about breadth in today's market. 387 of the 500 S&P 500 stocks finished in the green. It's a very, very broad rally. Feels like capital is not just shifting around in the market anymore, but like being redeployed to a certain extent. Dylan, GameStop here. I saw this headline too. This is point number 3. GameStop is considering investing in Bitcoin and other cryptocurrencies, sources say, according to CNBC, which has been briefed on the matter. To this point, they don't know if they would actually be able to deploy a plan. They are considering it. They don't have anything firmly set in stone, and they're just studying the matter. So naturally, GME here had a pop from about 26 up to about $31.50 here in the after hours because, heck, I guess we're doing the whole blockchain thing again, Ilya, like the Long Island Blockchain Co. Just gotta, how can we revive interest in our stock? Oh, let's just say we're doing something with crypto. Although, in
Polaroid,
fairness,
Polaroid
can I do that
crypto,
thing?
Was it? Or
I'll do that
Polaroid
thing.
blockchain, whatever it was.
Yeah, people seem to like that when you make crypto analysis. So tonight I'll be recording an hour-long, half an hour-long segment with NPR about the role of cryptocurrency in society, and I'll be making the argument that it's, a better use case than gold. I've been arguing that for years. If you're thinking about it as a store of value in a modern 21st century sense, so I will be sure to share that later because people seem to like the crypto stuff. Ilya, I was looking back at one of our PCM presentations that we did in 2021, and it's really interesting to see how, 3-4 years later, what has actually changed in the space and how treasuries and institutions have adopted it along the line that people were saying that they could back then. So is there any real use case still? I don't know, but do people believe it's a store of value? You bet. And that's good enough sometimes, even if we haven't put the treasury on the blockchain just yet. Dylan, what's the most compelling story for you in the market right now? If we think that the news that we're seeing is a lot of just noise and ultimately when rubber meets the road, it's not really a problem. What's the most
the
compelling
thing that I've been sort of, I'm sorry to be so Trump-centric, but the thing that I've really been thinking about is I do think that, I don't know whether to pull it off, but I do think that Trump's ego draws him to the appeal of positioning himself as the peacemaker president. And so if he can find a way to make a deal in Ukraine, now it may not be a deal a lot of people, it may be a deal no one else would make. There may be 1,000 problems with the deal. So I'm not saying that the deals will be good or in the interest of the United States for that matter. I'm saying that they may reduce conflict, yes?
Donald Trump just said there's a very big trade deal that will be announced in the near future.
Okay. Do we know anything else?
He's currently in a meeting with Prime Minister Modi in India. With Prime Minister Modi of India, not India. They're at the White House.
Could be exciting.
Just something to, again, watch.
But if you buy into the peacemaker president, I just think that oil gets weaker, or that energy resources get cheaper. If you believe Ilya's interpretation, which is economic activity is more likely to be marginally slower this year,
maybe not marginally,
and maybe not marginally if you believe Ilya, and you believe that Trump is positioning to be the peacemaker president, even if the way that he makes the deals is contrary to various national self-interests. All of those things speak to weaker energy prices, full stop. And so I actually am entertaining a bigger, larger, longer short oil position, as well as a long Dubai on peacemaker president marketing and reality, in the sense that I think will be less shooting in the short and intermediate term in the Middle East and in Ukraine, which will create less perceived immediate risk to energy supplies. And you combine that with a slowing economy, marginally or not marginally, as my San Francisco friend might say, all of those things posture towards a bigger decline in energy values and prices than the price reflects right now.
Ilya, tomorrow's retail sales report, is that something that you are particularly concerned with? It's really the only major data release on the day.
Absolutely. And I think the reason why stocks shrugged off CPI yesterday, ultimately, the reason why the dollar shrugged off CPI ultimately, which is actually kind of unusual. Typically, the bond market is the smarter of the bunch, but it had to wait until today and confirmation from PPI to rethink yesterday's excesses. But the reason that I think the dollar and stocks ultimately looked at CPI yesterday and said, this is not a reason to rally, but it's certainly not a reason to sell off, and ultimately ended the day flat, is because they looked at CPI and said, the internals of this are actually growth negative. The weakness here is in the service sector. That rhymes with the ISM and PMI numbers we just saw the previous week, And if the service sector goes, forget tariffs, forget all of these things. None of that would even begin to make a dent. At best, it would make things no worse if these things didn't happen. If they did, they would just add fuel onto something that is negative already. If what we saw in the PMIs is the beginning of something, then the global economy is in trouble. Now, we don't know that yet. It's 1 month's data, but it's 1 month's data from 2 independent sources showing very analog things, and then the CPI report reinforcing them. So now the retail sales number is a very big deal, because the real question isn't about tariffs or peace deals or annexing Greenland or taking over Gaza. None of that stuff matters that much, if at all. The real question is, China has stopped growing for a long time. The Eurozone has slowed down to a standstill. The only thing that's growing is the U.S. service sector, powered by U.S. consumers. Because most services are done, most of that business is done domestically. It's how the strong U.S. economy has not spilled over to other markets. Typically, that would be via U.S. buying of goods exports from everywhere. But the strength has not been in goods. It's been in services. And so if the U.S. consumer is on weaker footing here, and that's where this weakness in services is coming from, as the PMI suggest, because indeed the declines are in new orders and and employment in measurable forward-looking indicators. If that's what's going on, and we get a weaker retail sales report as another bit of evidence in this direction, forget all this noise. There's a cyclical downturn that was inevitable eventually, and maybe starting to show up. Now, of course, all of this is early evidence. We're going to get an update of the PMIs next Friday. So we'll see if there is a second dot in the series here. But the body of evidence to suggest that the U.S. economy cannot and will not forever be the sole pillar on which global growth stands, it's building. At the same time that the other pillars are not getting any better. So yes, of course, the retail sales number is a big deal tomorrow, if it misses.
This trade deal looks like it is with respect to India. Senior Trump officials saying that there is a goal to have a comprehensive defense and trade pact with India by the end of this year. It's interesting because the U.S. effective tariff rate against Indian goods is about 3%, while Indian tariffs against American goods is roughly 17%. So India being caught in the thrall of reciprocal tariffs would be an enormous increase there and could dampen trade. But there is also the opportunity that if we're careening, and as Marco Rubio, the Secretary of State, points out, as Pete Hegseth, the Defense Secretary, points out, that we're turning our attention away from Europe and going to focus more on China, India becomes a very valuable partner to resupply or rebuild supply chains in friendlier nations. Not that India is a particularly U.S.-friendly nation. It always had an intermediate role in the Cold War. Even during this whole Russia-Ukraine fiasco, it took more of a neutral position. But that is a friendlier location for factories manufacturing than China for American companies. So if you avoid those tariffs and you get a trade agreement here, a big bilateral trade deal, that is something that is quite fascinating with the world's largest democracy in India. Coinbase here, pinned. I guess we can say congrats to Tony. He's going to have a pretty easy show tomorrow, Dylan. Coinbase closed in at 298. We're basically flat at 301. Those big earning results didn't really translate into substantial moves across the board, at least in coin. Elsewhere, though, we had a few other earnings releases come here after hours. Palo Alto Networks, they came in. EPS was 81 cents versus 78 expected. Revenues just barely higher, 226 versus 224. Their guidance wasn't above expectation. So if you're not promising the moon right now, you're getting slapped around. On the other hand, Airbnb, 73 cents EPS versus expectation of 58 cents. Roku, likewise, another huge beat here. Their share price is up. Apparently, streaming is still popular. On the other end, Advanced Materials, they offer weaker guidance. Their share prices are down. EPS 238 versus 229. That is a consistent thing we've seen in this market, this earnings cycle, by the way, which is coming to an end. According to FactSet, companies that have been beating their earnings estimates are being rewarded less than average. In Q4 2024, companies that are beating their EPS estimates are seeing an average price increase of 0.3% the 2 days before the earnings release and 2 days after. That's below the 5-year average of an average price increase of 1% during that same trading window. Whereas the companies that are missing their earnings, they're seeing an average price decline of 2.4% 2 days before the earnings release through the 2 days after that release. And that is just slightly weaker than the 5-year average of minus 2.3%. So in this market, if you're beating and you're not giving even better guidance, you're